CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we're looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the large street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you from the CNBC-TV18 Motorola Oswal newsroom, and this actually is the newsroom. I'm Prashant. With me, as always, my colleague Sonia and Nigel. Guys, hi. Good morning.
Good morning and happy 25th. It's CNBC-TV18's 25th year. So happy birthday to all of us.
Happy birthday, guys. And, I just want to say very quickly, it's been 25 years of trust and timeliness, and I think these are the two things which make the market tick. So thank you, viewers, for staying with us these 2.5 decades as we've taken you through the ups and downs of markets. And guys, what a way to kind of bring in these 25 years, right, with the kind of market we've had over the last, 10 days or so.
Absolutely. You know, I just think, first of all, of course, I want to wish all our viewers a very, very happy 25th birthday, because without our viewers, we are no one, right? So it is because of our viewers. We have tried to, over the last 25 years, stay credible, stay loyal to our viewers, and more importantly, stay relevant, right, in today's day and age. And it's not just us. 3 of us are just the face of what you see. Absolutely. It's an entire machinery at work. All the producers, the directors, the technicians, the guest team, the research analysts working tirelessly day after day to put credible content in front of you. It's not easy, but it's a job that's got to be done, and the best in the business is doing it. So happy 25th to all of us, and more importantly, to the team that makes it work.
Well, you have said enough. Party time, guys. Party time. It's our birthday. Very, very excited today. And as you all said, we are here because of you all, and you all have made us. So thank you for staying loyal to us. And thanks, guys. Every morning we wake up to each other, right? It's great anchoring with both of you all as well, and the entire team that backs us up. And for me, this day is always special. It's my mom's birthday. It's my channel's birthday.
That's
so I'm
amazing.
extremely excited today.
It's double dhamaka.
It's double celebration. Triple, yeah.
And I've been here for more than half the journey. So very, very special moment for all of us, for all our viewers, and we thank you.
Wish a happy birthday, Nigel. I mean,
I've been doing it for the last 13 years, so happy birthday, Mom.
Happy birthday, Auntie. It is a big day for all of us. But you know what? I do want to also take this opportunity to thank everyone here, even our viewers, right? Because we learn from them every single day. And in today's day and age of the digital landscape, you get so much feedback from your viewers as well, and that's how we are sort of evolving across, media platforms.
It keeps us on our toes,
It
doesn't
does,
it?
it
Every
does.
single day, and it's instant. So actually, it's actually sort of a great day, and we'll continue to get you snippets of the journey over the last 25 years. You'll get to see a lot of the team as well. What Sonia was talking about, the back-end team, which puts this program and other programs through the course of the day together. So we'll do that. But we've got a market to track, so let's kick this off in terms of what you need to know. We're waking up to not so kind of global cues. Let's just start with where we left off yesterday. We've had an incredible run, and how incredible? 1,000 points worth over the last 6 days on the Nifty is what we had. And that's what I was saying. What a way to kind of bring in this these 25 years. So we closed on the Nifty decisively above the 20,850 level. Actually, the first close above the 20,850 level happened day before yesterday, but it was just about 5 or 6 points. Yesterday was much more decisive with about a 0.5% gain, which came through, once again. So, the FII positioning in the derivatives market, which something we've highlighted all the way since Monday when we began. And by the way, we came into this week with FII's net short, some 47, almost 50,000 contracts on the index futures. Yesterday, it was next to nothing. Today, FIIs actually are long, 23,000 contracts long on index futures. And the reason this is important to track is, as the market has done very well over the last 3 days, and actually, even going into these election results, so the total is about 6 days worth, 1,000-point rally. The comfort or the cushion which comes from short positioning, that kind of is gone now. FIIs are long, 23,000 contracts, but it's nowhere near exuberant kind of levels. All right, let's rewind the clock back. Overnight cues, not very much to talk about. Nasdaq was down about 0.6%. The S&P lost a little bit. You got the 10-year, which lost about 5 basis points. And you have the dollar index, which is above 104. It's been, not really decisive one way or the other for the last 2 or 3 days. And the market here has kind of moved to its own tune, to its own beat. Oil prices had a significant move. They were down about 4%, but in terms of a driver for this 4% sell-off in oil, not really. It looks like general risk reduction, which played out and showed up in oil as a commodity as well. I said this yesterday morning, same time. Maybe things at the margin in the very near term are getting a little stretched. So the daily RSI, for example, which is the relative strength index, a simple way to look at sentiment, that's at about 84. So we are, technically speaking, a little overbought. If you look at hourly sort of indicators, technical indicators, it looks like momentum is starting to fade a little bit. You got hints of that yesterday. I mean, the market was not able to kind of, rip through like what we've had the previous couple of days now. So that is point number 2. But I would say this as well, there is no clear sign of a significant price reversal yet. You need to get that. And how will you know if you're getting these price reversals? You've got to look at levels. So on the way down, the Nifty has got near-term supports at 20,795 and then 20,545. These are basically the 20 and the 40 hourly moving averages. I think once you get a close below the 40 hour, which is about 25.45, then you will think about maybe a pullback which may last beyond a couple of days. Otherwise, right now, dips will be bought. Dips to 2,700, dips to 2,500 most definitely will be bought. Bank Nifty had a bit of a divergence. It closed in the negative yesterday, so that needs more watching. Before this rally started, the Nifty Bank was the weaker of the two indices. So here, supports for the index come in at 46,674 and then 45,875. Again, these are very near-term hourly averages that we're looking at. And on the upside, I would still say on the Nifty Bank, a move to 47,700 is pending. But will that happen before, in a breathless kind of fashion, the market we've had, or will it happen after a bit of a pause? I would say that after the rally that we've had, wait. You will get pullbacks. Maybe it'll just be a day's worth, or 2 days worth. but the risk reward right now with the rally that you've had in the very near term, and especially if you're trading, perhaps has turned a bit more unfavorable. Sonia.
Absolutely. I mean, there's nothing to complain, right? In this market, some consolidation is always a good thing. And I think as we've been saying before, when it rains, it pours, and it's pouring good news for the market. The additional good news that we have this morning is crude, and I'd like to pull that up. I mean, I think 5th day running crude has been falling now. It's now below $75 a barrel. It's a big positive, and this is ahead of the RBI policy. So that's another thing that the bulls will latch on to, the fall that we've seen in crude prices. So that's a positive. But the US markets, they ended with mild cuts overnight. In fact, it's been the third losing day for the US markets. So in that context, won't be surprised to see some sort of consolidation in the market in the next couple of days. Let's not forget the Nifty is up 4% in just 5 trading sessions. That's been the kind of rally that this market has seen over the last many days. And perhaps the Nifty could consolidate around the 21,000 mark. But what's important is that the bottom of this market has moved up. Now, the floor for this market has now moved up to around that 19,000 level, and that's an important thing to keep in mind. Domestic institutions bought about 1,400 crores in the cash markets. FIs continue to buy. In fact, FIs have bought almost 9,000 crores in the cash markets this month so far, and we're not even in the, the 10 days in the month, not over just yet. So big buying from FIs. Now, tomorrow you have the RBI policy, and that's the next big trigger for the market. Maybe not in this policy, but the market is now bracing itself for possible rate cuts, both from the US Fed as well as from the RBI. The expectation is that it will happen in the first half of 2024. So that's going to be the next big trigger for the market. But for now, the Nifty could consolidate around that 21,000 mark. There is a pre-election rally that the street is looking at. So when this consolidation ends, that pre-election rally is something that could take place, perhaps take the market to 22,000 as well. Time will tell. And there's a lot of value that's still left in large cap stocks. So let's not forget Reliance, HDFC Bank, Infosys, HUL, ITC are all still 10-15% away from lifetime highs. So perhaps there's better opportunities in large caps compared to mid caps.
Well, that's right. Guys, what a rally we have seen, right?
Yeah.
7 straight sessions, you end higher. That's telling you the kind of rally that we've seen on the markets itself. And for me, there are 2 big triggers from here on. Yes, the retail participation is good, and all of us have been putting in money, via the SIP route as well. And that's very encouraging. But for the markets to move up from here, you require the hot money, the FI money, the institutional money needs to come in there. And also the Nifty Bank, that will have to perform from here on. Maybe both those 2 points, they're actually interrelated with each other because the FIs have to come in. Remember, the exposure in India close to around 32-33% is towards, banks. So both those 2 could be interrelated. Now, the FIs, they're net long on the index. So that's going to be very, very important. And just take a look at the chart on your screen. They are net long for the first time since the 22nd of September. So that's the kind of short covering that we have seen. We have a swing factor out there of close to around 2 lakh contracts. From being a negative, 1.75 lakh contracts on the short side, now you're going with a net long position of more than 20,000 contracts. So big swing factor has already taken place. Bulk of that short covering has taken place. Now all eyes are on the institutional buying. 2 strikes were very active yesterday, 20,900 put as well as the 20,950 call. And just plugging in both those 2 numbers, you get your levels out there. So the near-term support level for the Nifty will be yesterday's low around 20,850 and plug in the options data. Since the 20,900 put was seeing some writing, plug in close to around 70 rupees on an average, well, you'll get 20,830 odd. That should be the important number. The levels come up for you on the screen in just a bit. Resistance level, since the 20,950 call was very active, and the premium ended close to, it was on an average at the start of the session close to around 90 rupees. Well, you get that resistance level of around 20,040 odd. The Nifty Bank, that holds the key. It's rallied in the last 10 days or so, but it's an underperformer year to date. So the year to date chart should come up for you. That's still up only around 10%. The Nifty is up close to around 15%. You want the Nifty Bank to do a catch up of sorts. If that happens, then the Nifty is well and truly on its way to higher levels. But that holds the key. Nifty Bank and the institutional numbers are very, very important because bulk of the short covering has already taken place.
A lot of people on Twitter, etc., have been asking this feedback that you're talking about, that what should we do? Should we book profits? And even, anecdotally, whether it's been such a sharp rally, right? Yeah. Truly historic. So what I've been saying is, if you can stay invested, just stay invested. Don't forget about it. You'll get pullbacks along the way, but there's no real reason to get out because the market has moved 5% very quickly. It is quick. It is very quick. Yeah. Of course, if you're trading, then it becomes slightly different. It becomes trickier, and then you've got to take sort of, the day-to-day into account.
Yeah, I think, currently, at current scenario, you're basically building your portfolio for the next 5 to 7 years odd. Because in the next couple of months, anything can happen. In the next, 12 months or so, anything can happen. But when you're buying good quality stocks, for a longer duration, I think it's that phase where you want to participate on the upside. You want the kids to have a great future, so keep the money coming in.
And also the good part, I guess, is that large caps have not participated yet, right? So if you have this FOMO feeling that, oh, the market is at all-time highs, I haven't participated. But guess what? All the large caps have not participated either. So perhaps this is the time when you go out there and put your money to work.
Absolutely. Well, we'll continue to discuss this. We'll get you lots of views. So let me give you a quick teaser of what's coming up here, right? It's our birthday, and we have a very special lineup of guests for all of you through the course of the day. Biggest market voices will join us. James Sullivan of JP Morgan will be with us. S. Narain of ICICI Pru, Samir Arora of Helios, Sridhar Sivaraman, and Nilesh Shah are some of the faces that you will see here over the next 2 hours or so.
All right, that's not all. The Best of India Inc. is also on your channel today. Dinesh Khara of SBI, Rajesh Jejurikar of M&M, R. Shankar Raman of L&T, Shenu Agarwal of Ashok Leyland, Prabha Narsimhan of Colgate Palmolive, Ramesh Swaminathan of Lupin, Viren Shetty of Narayan Health, and Atul Lal of Dixon Technologies.
At 10:30 today, market veteran Ramdev Agarwal will join us as our guest editor on the program, where he will discuss the rise, the fall, and the resurgence of Zomato. Zomato is Ramdev's big bet right now, so stay tuned to CNBC-TV18 for an action-packed day.
All right, well, first up, there's so much happening in the next 2.5 hours, so keep it with CNBC-TV18. But first up, let's start with the equity view coming in this morning. We have Amit Sachdeva of HSBC, who says that many positives are coming through, from solid earnings to falling US yields, which are driving the view that the bull market will extend into the first half of 2024. However, next year will be different, as the general election will make the market more volatile, and a fractured mandate is a key risk. Banks, healthcare and energy are the sectors that are favorably positioned. We also like autos, retailers, real estate and telecom. Sectors that are unfavorably positioned include FMCG, utilities as well as chemicals.
Well, some views on the rupee as well. This is Parul Mithil Sinha of Standard Chartered Bank, who says that the USD INR continued to trade in a narrow range during the week, despite good equity flows on positive sentiment post-state election results. Lower oil prices, weaker dollar. On the back of these, she expects the pair, the USD INR, to trade between 83.15 to 83.45 to the dollar next week, with markets closely watching US non-farm payrolls data and the MPC outcome here in India, both tomorrow.
Okay, and on the bonds, Parul says that the India rates remained in a very narrow range despite a sharp down move in global rates. She says global rates markets have priced in an aggressive rate cut from the FOMC in 2024, and she also talks about how domestic rate markets continue to be constrained by tight interbank liquidity and large supply of corporate papers. She also adds that the RBI MPC is expected to maintain a status quo on policy rates in the Friday MPC meeting, and the markets will look forward for any pointers on liquidity.
Well, let's run you through the top 10 list, and later on we'll get in further details on that. For the time being, we'll just run through the list. We're looking at Network 18, we're looking at TV 18, a couple of more stocks, BEL, SpiceShare. Their stocks will be reacting to positive news flow. While on the flip side, your Bharti Airtel, Paytm, IDFC First Bank, Ircon International, ONGC and Oil India, all of them will be reacting to negative news flow overnight.
All right, well, let's welcome in our first guest. James Sullivan is Managing Director, Asia Pacific Equity Research at JP Morgan. He's with us on the program. James, great to have you with us here. Appreciate your time on CNBC-TV18. I just want to start with whether in the US there is a sense developing, and one is reading and hearing about it more and more, that bullishness is at a bit of a peak level. There are no bears left anymore. The institutional survey, which is widely followed, that was quoted as kind of pointing to euphoric kind of levels. Is that so, James? What's the house view in terms of markets in the US from here out?
Good morning. Thanks for having me on the program, and happy birthday to both the channels and relevant mothers. So hopefully everybody's having a good day. No, look, it's a great question, and I think you're very clearly seeing that in share price action. You're seeing markets go on a year-end rally in the US as well as in many markets here in Asia. The JPM house view is that that rally will continue through year-end. The difficulty that that presents from a 2024 perspective, though, is that you set expectations and the overall bar very high walking into next year. So we do see the potential for some market performance early in the year, very front half loaded. The challenge as we get into the second half is we do see an economic slowdown globally. We do see downside to earnings here in Asia for MSCI Asia Pacific. The street's looking at $51 in EPS estimates. The JP Morgan view is $48. And so not massive downside, but a negative earnings revision cycle. And you are likely to see changing expectations in terms of the potential for rate cuts. The market's priced in 100 basis points of rate cuts in the first half of 2024. JP Morgan House view is that's much, much more likely to be second half biased with the potential to push into the following year. So you exit this year very strong, very high bar going into 24. Again, some opportunities for strength, particularly off the back of idiosyncratic election timing in the first half of the year in many of our Asian markets, but then a significantly more difficult picture in the second half.
Okay. James, thank you for your wishes and happy to have you here on CNBC TV18 in a special moment. How are you feeling about a market like India? You know, we were just having this conversation about how if you would have stayed invested for the last many years through thick and thin, you would have created a lot of wealth for yourself. Do you think that continues to be the case in the Indian markets? And what is your advice to retail investors watching you right now?
So look, overall, JP Morgan is overweight India looking forward into 24. The backdrop for that is a combination of growth, which we've talked about on prior programs, but also recognition that India is running the highest corporate ROE out of any country in Asia right now. And so you're not only seeing growth, but you're seeing extremely high quality and high return growth. And we do expect that that will continue. As you noted earlier in the program, the market index right now has largely been driven by mid and small caps. We do see opportunity in the large cap space, particularly in the financials and some of the consumer names. So we do see the potential for the market continue to roll from here. From a short-term perspective, looking at market positioning is extremely important. In our year ahead note, we had published the fact that foreign investors were underweight India. As you noted, that is already starting to mitigate, again, setting that high bar as we go into early next year. But from a full year 2024 perspective, we're looking at the Indian index, base case trading around 22,000, bull case trading around 25.
Hi, James, and thanks for your wishes, both personally as well as professionally. Well, what about China? You know, a couple of months ago, it would be logical to see some kind of money move there, some kind of interest coming into China. I'll tell you what, from there, India's widened the gap, and we have outperformed even more. Do you think Chinese markets at some point of time become attractive, or do you think investors would rather stay with earnings growth, with better, stability at the center? Your view?
So we think the China market is attractive right now. I mean, there's two ways of looking at it. From a broader macroeconomic perspective, you saw 1 trillion RMB in stimulus in October. The rumor is that we're likely to see another trillion coming out of the PBOC in the months to come. You are looking at an easing environment as we enter into the top of 2024, and the potential for a pickup in overall economic activity, which we're starting to see in a mixed way in some of the high-frequency data points. We think those will strengthen as we look forward into the top of next year. From a bottoms-up perspective, however, it's important to note that there are stocks and sectors that performed extremely well as we looked through 2023. And so one of the core discussions that we're having with investors regionally, but particularly relevant to China, is to some degree, let's ignore the index and let's recognize the fact that China pure EV stocks are up over 50% on a year-to-date basis. Elements of the China tech stack, despite the potential for geopolitical tensions, et cetera, are up over 60% on a year-to-date basis. So you've seen a massive dispersion in sector performance in China, which offers significant potential for investor returns if we're doing the bottoms-up work, if we're analyzing company and management level decisions in an era of very significant change.
So, James, you know, the next big trigger for this market, both globally and locally, seems to be the impending rate cuts, right? The expectation is that it will happen in the second half of the calendar year 2024. Is that your base case as well, both for India as well as for the US? What are you penciling in?
So we are looking at the potential for rate cuts in the second half. The view from a JP Morgan perspective is that roughly a 60% chance of a recession as we look forward into the second half of 24, first half of 25. That would give the Fed significant and ample room to look at rate cuts. However, that would result in a downdraft to both global economic activity, which has a significant impact on us here in Asia. Asian markets in general are very linked to global exports, and as well as a downdraft in the potential for consumer spending. And I think the latter is a very important point to make. If you look at the upside surprise in consumption expenditure, particularly in the US, it's segued from excess savings that were built up during the course of the pandemic to really wealth effects on the increases in both real estate as well as the overall equity market in the US. If that starts to roll over, we would see a significant impact on consumption trends, beginning in the US and potentially in some Asian markets as well. So again, bottoms-up work, doing the analysis on sector specifics to understand the relative dispersion trades, both across markets as well as within markets, is absolutely critical as we look into second half of 24 in particular, because we are looking at very high levels of market volatility.
Okay, James Sullivan, as always, thank you for joining us, and especially on a day like today when we have big celebrations, thanks for being a part of our big party here on Dalal Street. Thanks for joining us. Okay, guys, you know, we were talking about staying invested in this market, right? Just got some data. 25 years ago, the Nifty was at what level, you know? 845.
Wow.
Yeah, so it's gone up 26 times, right, in 25 years. I mean, so it just goes to show that A, the power of compounding, B, patience, right, in this market is something that always works.
Oh, absolutely. If you have time on your side, it kind of papers over a lot of mistakes. I mean, even if you buy a little expensive, but if you hold on for a longer period of time, I mean, you tend to make money. You know, James made a very interesting point. The strength of the equity market, I think we don't talk about it too much, but it's responsible for this, what we describe in classical terms as wealth effect, right? Yeah. People feel richer. And I think so much of the consumption, he was talking about the US and how that strength in US equities is driving real estate and high-end consumption. I think it's absolutely true here in India as well.
Absolutely.
You know, a lot of the premium housing, I think I'm convinced, is, and we've asked real estate companies, I mean, of course, they don't have the data, but it's a cycle. It's a virtuous cycle right now, one feeding into the other. But I think it's worked so well over the last couple of years.
You know, Prashant, just to plug in that point, if you're buying expensive as well, I had a chat with Monish Pabrai, and he said when Charlie Munger and all, they went ahead and they bought C-Candy. They bought it at expensive valuations. It wasn't very cheap. They paid $25 million. And dividends from then on, you know, in the last 30-40 years, they've got $2.5 billion.
Wow.
Now, that's only in terms of dividends. Forget about the way the asset has moved. So you buy a little bit expensive, good quality, just sort of relate that as well.
Those guys are very different. Like I remember there was an interview in which Buffett says, he says, you know, we didn't hire investment bankers, we didn't hire, you know, specialists to analyze C-Candy when they bought it. You know what they did? They went and bought a box of chocolates and they had it. And I said, well, this, you know, of course, the folksy charm of Buffett and Munger is legendary.
And that's what led them to Coke as well. The Coca-Cola investment 8-10 years later, that, you know, that's what led them to that.
All bad habits working well for them, working really well for their portfolio. All right, let's step into a quick break. On the other side of the break, our entire team will be with us to help you with the top 10 stocks that you need to watch out for today.
You continue to be the first port of call for actionable, credible, verifiable information for news.
CNBC-TV18, one goal, pursuit of excellence.
Over 2 decades of setting gold standards, over 2 decades of excellence.
All kinds of news starting from sports, politics, international affairs, cars, entertainment and whatnot.
Journalistic credibility at its finest.
One should watch CNBC-TV18 because you know what, you'll hate to miss out on that money-making opportunity.
One reason to watch CNBC-TV18 to stay ahead in the game.
Watch CNBC as we get to you the most unbiased and factual coverage of the ever-changing business landscape.
You need a reason to watch CNBC-TV18. I mean, is there anyone else who's as good?
Watch CNBC-TV18 because it has, is, and will always be the business leader.
Watch CNBC-TV18 because the team and its work here just would not leave any alternative for you.
You know we're the market leaders, right?
Credibility and accuracy, no doubt about it.
Watch CNBC-TV18 because we're in the business of creating wealth.
Best analysis in real time.
Well, we keep it classy. We're always with the news. We're the best in business.
And also because I'm on it.
Yes.
We're the best and we just keep getting better.
Decoding financial jargon for the last 25 years.
Keep watching CNBC-TV18
to stay ahead of breaking news in the world of business, ahead of when it actually happens.
Watch for news on the go. Here's to the heart and soul of news, to the stories told and the milestones achieved.
It's a road to financial success.
Please watch CNBC TV18 for responsible journalism.
Come on board with us and reach newer heights.
If you have to trust financial news, then it has to be CNBC TV18.
Well, watch CNBC TV18 because we are the best in the business.
Keep watching CNBC TV18.
CNBC TV18, embarking on a quarter century of excellence.
Well, if you've just joined in, we're here at CNBC TV18 celebrating our 25th birthday, 25 years of excellence in journalism, 25 years of bringing you the most credible news and, of course, staying relevant as well. So thank you to all our viewers once again for tuning in day after day. Our entire research team is joining in now to help us with the list of stocks you need to watch out for as we begin the day. First up on our radar is Bharti Airtel. So we have Rima joining in to give us more on that. Rima, over to you.
Hi, good morning. So Bloomberg has reported that Warburg Pincus is looking to sell $211 million worth of shares in Bharti Airtel via a block deal. Now, this amounts to roughly 1,750 crore rupees. Warburg is offering 17.5 million shares at a floor price of 1,005 rupees, which is at about a 1.9% discount to where the stock closed yesterday. And after the sale takes place, Warburg would have offloaded their entire stake. They would no longer be holding any shares of Bharti Airtel. But this is what Bloomberg has reported. CNBC-TV18 has not independently verified the news, and as of now, we do not even have clarity on when the block is going to be taking place. Warburg has been periodically bringing down their stake. The last stake sale took place in June when they sold about 1.9 crore shares at a price of 868. Back to you.
All right, thanks a lot for that, Reema. Well, Mangalam joins in as well to tell us about TV18 and Network 18, the merger details. Mangalam?
Well, the big consolidation was announced as far as TV18, E18 is concerned. Both of them will merge with Network 18. The merged entity will comprise of all the digital TV and news assets of the conglomerate. In fact, if you just want to apprise the viewers of the portfolio, TV18 has 20 news channels in 16 languages and CNBC-TV18.com. Network 18 has the News 18 platform across 13 languages and firstpost.com, and E18 is the one that owns and operates the Money Control app as well as the website. Even Viacom, which is a portfolio of 40 TV channels and Jio Cinema, will continue to be a direct subsidiary of Network 18, and Network 18 will continue to hold its investments in Book My Show. What is the merger ratio? At 100 Network 18 shares for 172 TV 18 shares, the merger ratio from a listed entity standpoint is largely at par. E18 shares holders will get about 19 shares of Network 18 for every 1 share that they hold in E18 itself. From a consolidated numbers basis, this does not change much, largely because these companies, are included in the consolidated numbers of Network 18. But the company has said that integrated entity for news gathering and dissemination to result in cost and content synergies. So to that extent, we will see positive moves on the counters. Both of them were higher in yesterday's trading session as well. But all of this with the disclaimer that they are owners of the channel that you love and watch.
All right. Thanks very much, Mangalam, for that. Paytm perhaps could see some red today. Now, the smaller ticket loans which Paytm sort of gives out, it is going to have to dial it back. This, of course, comes after the RBI increasing risk weights on lending on the unsecured side. Abhishek is standing by with what the street is making of it. Abhishek, take it away.
Well, to begin with, Paytm in the presentation did mention that there is good demand seen in higher ticket size loan, that is loans between 3 to 7 lakh ticket size in the low risk personal as well as merchant loans. In consultation with lending partners like Aditya Birla Finance, etc., Aditya Birla Capital, etc., they will reduce less than 50,000 ticket size of loans and expand into higher ticket size loan. So merchant loans that they give out is to MSME segment, and it is a secured loan. Because it is a business loan, and hence it does not get impacted from the RBI regulatory point of view. They'll continue to build on loan distribution business, and they will expand their lending partner base. 1 large bank and 2 NBFCs in Q4 FY24 and in Q1 FY25. Now, Jeffries has written on Paytm, they have a buy recommendation. Target price has been cut to 1,050 from 1,300 earlier. They said that the BNPL, buy now, pay later, recalibration follows system tightening. So these disbursers, the BNPL disbursers, form about 55% of overall disbursers, and they will halve in next 3 to 4 months. So the impact on loan growth disbursers is for FY24 from 98% it comes down to 65%. For FY25 from 49% it comes down to 5%, and for FY26 it comes down from 43% to 27%. So the revenue cut estimate is between 3 to 10% for FY24 to FY26, and the impact on EBITDA adjusted for ESOP is at 14 to 16% over the next 3 years. So they also say that re-rating will take some time. Back to you.
Okay, thanks a lot, Abhishek, for that. We'll keep an eye out on Paytm. But let's hop across to Vivek. He has a bunch of stocks on his radar. Vivek, what are you looking at?
Well, quite a few stocks on the radar. Let's first start with IDFC First Bank. So sources tell us that Cloverdale Investment, that is a Warburg Pincus affiliate, would be pairing almost 1.3% out of the total 2.74% stake that they held in the company at the end of the September quarter. The deal size is close to $100 million, and the floor price is at 85.7 rupees a share. Remember, even in September, they had pared down some stake. The other stock on our radar is IRCON. Now, the government is looking to sell up to 8% stake in the company, and the route that they've chosen is the OFS route. The base size of this particular stake sale is 4% of the total equity, with an upsize option of another 4%. The floor price price for this particular OFS is at 154 rupees a share. The stock has seen a stellar rally in 2023. The other stock on our radar, Bharat Electronics, the company has updated the exchanges about the orders that it has received. So total orders worth over 3,915 crore is what the company has received. And along with that, the company has also received an order worth 580 crore from the Indian Army. Now remember, this takes the total order book of the company in FY24, the total order inflow rather, to 18,298 crores. So the company has already managed to achieve 91% of the total order inflow guidance for FY24. So likely to exceed the order inflow guidance, like the management told us earlier as well. And lastly, SpiceJet, the board meet, that's been held on December 11, 2023. Fundraise is going to be considered in this particular board meet via the preferential issue basis.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Manisha. She's joining to tell us about the overnight, slip that we saw in crude oil prices. Morning, Manisha.
Morning, Nigel, and thank you for that. Well, yes, a 4% decline, and that has brought us down to 8% in this week itself in terms of crude oil prices. We're trading at a 5-month lows, and it's not just the crude oil prices. Natural gas is trading at a 13-week lows. Gasoline is at a 1-year lows as well. The strength in US dollar and the expectation that you could be looking at weakening demand going forward is weighing in case of the crude oil prices. The markets also are dealing with weak PMI data from Japan, US, and Eurozone in the month of November, and that has been weighing on as well. It also is about the Chinese demand, which has been uneven, and the Moody's outlook or negative on China has weighed onto the prices quite strongly. It is going to be about the U.S. non-farm payroll data tomorrow that the street will take cues from. But at this point in time, since we've broken below $70 already, the street does believe that 68 and 66 could be in sight soon.
All right, thanks a lot for that. Well, here's a quick recap in case you missed out on any of the stocks with positive news flow today. There's TV18 Broadcast, Network 18, BEL, and SpiceJet. While stocks with negative news flow this morning, there's Bharti Airtel, Paytm, IDFC First Bank, Aircon International, ONGC, and Oil India.
All right, well, we'll come back with more on each of these names as we go on, but we'll take a quick break here. On the other side, Deepan Mehta, Director at Elixir Equities, will be joining in with what bets he'd like to make after the rally that we've had. That's coming up.
Happy birthday, CNBC TV in India.
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. Hope you're having a good morning. Well, for us, it's a great morning because it's our birthday. And to join in the celebrations, we have Dipan Mehta, Director at Alexa Equities, who joins us on the show. Hi, Dipan. Thanks so much for joining in. And thanks so much for being a support over the last many, many years to our channel, educating us, educating our viewers as well. Dipan, let's discuss a few stocks. Rima was telling us earlier there's going to be a large trade on Bharti Airtel. So that one could open up a little bit on the red, but it's been a strong stock. What's your view on that one?
Good morning, Nigel, and thank you for having me on your show. First of all, congratulations to you and entire CNBC team on Silver Jubilee. It's been a fantastic journey, and I'm really privileged to have been a part of it. Coming specifically to Bharti Airtel, I think the stock has done pretty well over the past few quarters or so. And the most important aspect is that gradually we are seeing positive cash flows because 5G investment is reducing. And the entire telecom space is clearly a duopoly. The only kind of fly in the ointment, so to speak, is the increase in ARPUs, and that's not as per what Street is expecting. But at some point of time, I think that should also start kicking in the form of higher usage or in the form of making adjustments to their plans, which can derive a higher yield. So very positive on the company, and I think next 2-3 years could see very good earnings flow because of higher operating leverage.
Okay, Dipan, hi, good morning, and thanks for joining us. And, I mean, it's as much your birthday as it is ours, right? I mean, you've been a part of this journey through thick and thin. But let me talk about some more stocks. We were all discussing how the large caps have just not performed this year, whether it's Reliance, HDFC Bank, Kotak Mahindra Bank. Do you think the time is now? And as a retail investor, is this a good time to be putting money to work in some of these large cap names I mentioned?
Good morning, Sonia. See, end of the day, these small mid-cap stocks do take their PE multiple guidance from the large cap stocks. So at some point of time, unless the large cap stocks don't start to move up and their PEs do not get re-rated higher, there's only so much that the small mid-cap stocks can also move up. So very positive on large cap stocks. It's only that the FI selling was keeping them pinned down for so many months or so. But now that has turned positive, I'm very confident that large cap stocks will also do very well. Their valuations are reasonable, and they have underperformed. There's some amount of margin of safety also over there. And when markets are overheated or slightly overheated as they are just now, and you still want to put money to use, then it's better to go for safer investment in the large cap stocks rather than the small mid cap, where a bad quarter or a bad news flow can have a exaggerated effect on the negative side as well. So I'll be a bit cautious on mid cap stocks, small cap stocks because of the valuation. But if I have to put money to work, then large cap is where I would look at putting my money.
Dipan, when the RBI regulation on risk weights came through, I think that is still being understood, right? I mean, take Paytm for an example, as we were talking about it earlier, smaller ticket size loans. And I think we will continue to hear more and more about how banks and financials will moderate growth targets, etc., going forward. Any thoughts here on Paytm, if you want to add anything, or any of the other names there? Because financials as a space is seen to be, because it's not performed, is expected to do well.
Good morning. See, I think that the RBI move is phenomenal. I've lived through the IL&FS crisis and so many other banking crises. And I think the RBI is acting ahead and making sure that we don't have a crisis in the small lending, unsecured loan space. So although there is short-term pain, there could be long-term gain. And in fact, the kind of earnings growth which NBFCs and banks can generate could perhaps get extended. Maybe the NPA cycle also is further down to the future because of this RBI measure which they have taken. And they may take further measures as well if the kind of loans do not moderate as they want them to. And coming specific to Paytm, I think Paytm has got so many, revenue streams that if something is not working out for them, they'll start to focus on the other revenue streams. And they can always move higher on the ticket size. The main advantage of Paytm is the users that come on their platform and the ease with which they're able to do transactions over there, be it lending or be it insurance or even some of the other financial products. And from that point of view, I think that remains a compelling investment proposition. So I'm just waiting for the quarters in which Paytm starts to turn positive. Again, these are great businesses with very high operating leverage. So once the revenue starts to grow, most of it start to go to the bottom line once the kind of expenses also stabilize. So I don't think that it's something to be so concerned about, and it's very aggressive management. They will make adjustments as they go along.
Okay. We have many more questions for you. I do want your thoughts also on defense, right, which is a big space that has come back now despite the kind of rally that we've already seen. So more on that in a bit. We'll take a short commercial break. When we come back, we'll get you an excerpt from our exclusive conversation with S. Naren, the Executive Director and CIO of ICICI Prudential AMC. That comes up in just a bit.
At Taj, we would all really like to congratulate CNBC-TV18 on their 25th anniversary. And what a coincidence. We are celebrating 120 years of Taj. You're celebrating your 25th anniversary. We have a wonderful partnership. We wish you all the very best. Also for the coming festive season. Happy holidays, and wishing you the very, very best and a very strong partnership with our group going forward.
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. We're about 5 minutes away from the pre-open session. It's a birthday, and we have a very special lineup of guests for you all through the course of the day. I caught up with S. Naren, He is the Chief Investment Officer at ICICI Prudential AMC, one of the largest fund houses. Naren, of course, is a steadfast value investor. He believes that Indian macros, the economy is in fantastic shape. The only squibble, according to him, is valuations. Listen in to a small portion of that conversation.
India is in a fantastic place, except that Indian valuations are completely different from the rest of the world.
Right.
If you look at it, that valuation expansion has continuously happened.
Right.
That's all. But otherwise, if you look at it just from the point of view of outlook, I think there is nothing to say that there's any better country than India.
Right.
All the other countries have serious challenges in one form or the other, whereas India doesn't have those challenges.
Okay, so let's narrow it down. What's the big message? The consensus for some time has been, and you've been saying it as well, focus on large caps, don't focus on mid caps and small caps if you're putting fresh money to work.
Yes.
Is that the main message?
Yes, absolutely. And the other message is clearly that you can't predict the top of this market. Because the top of this market will be determined by how much foreign flows come in 2024. It can't be predicted by local flows because local flows have been very good over the last 2 years. They've taken markets to where they are without foreign flows. So markets can absorb a lot of foreign flows and the markets can go up to the extent that foreign flows come in 2024. Almost everyone we speak to say that foreign flows are yet to start. So if they come in a big way, you can have a much bigger move and that will be obviously more large capish. But how much they will be is something which people can't predict because it depends on how the US economy shapes up, how US interest rate shapes up. And those kind of factors will play a role in determining how much foreign flows will come.
But again, to that point of mid caps and small caps, are you saying that if you put fresh money to work in mid caps and small caps, be prepared for below average returns over the next 3-4 years?
Yeah, there we have a simple framework. We call it the boom cycle. In a boom cycle, when people invest, you don't make big returns in the medium term. And that boom cycle has been clearly seen in mid caps, particularly in the last 6 months. And in that framework, we've always seen that if you invest in any boom cycle, whether it is IT in 2000, whether it is infra in 2007, whether it is small and mid cap in 2017, again now, you don't make money in the medium term. You will make money in the long term, but you won't make money in the medium.
So what is the thing to do for people who are watching for inflows into equity funds has been extremely strong. Inflow into equity markets have been very strong. New demat account openings have been through the roof. But where should investors put money, fresh money in?
So I think, at all-time high, all-time caution is required. And, in the years of investing that I have seen, how do you practice more caution at the top? That's the toughest challenge.
But you're not calling this a top. We don't know if this is the top.
This is not the top.
Right.
All-time high is a period where you have to exercise more caution.
Right.
And the areas where people have to actually exercise more caution is not in mutual fund and hybrid. It is if you invest through derivatives, for example. If you invest in IPOs, for example, in sectors which you don't understand. These are the areas where people have to actually exercise more caution. And that is our learning from the past. And we always tell people, look at simple indicators like price to earnings, price to book, dividend yield, return on equity. If you're able to identify these things more clearly in a stock, you're in a safer company. Otherwise, you have to do much deeper work on that company to decide whether to invest or not to invest.
Well, time to slip into a short break. You come back, we'll get you market opening. We'll also get our technical experts who'll be back with us.
CNBC-TV18, embarking on a quarter century of excellence.
Okay, as we celebrate 25 years of excellence in journalism and business news, we welcome two guests on our show who I think have been with us through the course of this 25-year journey. Mitesh Thakkar and Sudarshan Sukhani are joining in. Sudarshan, I know for the fact, has been there since the very beginning. So, Sudarshan, it's a happy birthday to you as well, and to, of course, all your viewers, your followers, etc. It's been a great ride so far. And how are you feeling about it now? And what do you think the way forward could look like on the index?
Good morning and thanks, and a happy birthday to all of you and all the viewers. And I think CNBC brought about a revolution in financial broadcasting and information, and that persists and continues. Now, this is about the markets today. The Nifty is in an uptrend, an appropriate position for the CNBC birthday. It's likely to continue to be an uptrend, so the trade is very simple: buy every dip.
Okay, the trade is to buy every dip. Mitesh, happy birthday to you as well, and to all of your followers. Thank you for staying with us through the course of it all. Do you think the market now is getting into some sort of consolidation phase, or do you think the uptrend is pretty much intact?
Morning, Sonia. Birthday wishes to the entire CNBC team and the viewers. On the markets, I think that we are in a strong uptrend. Now, what has happened in that is that in the last 3-4 sessions, we have had a very strong rally. So, you have some overbought readings on the intraday charts. The hourly and the 2-hourly charts are now showing some kind of overheated situation. But if you look at the slightly longer term time frame, I think the markets are possibly heading towards 22,000. And since you're in a new high and you typically don't have any historical resistance, good chance that we might actually keep making higher highs till we get any signal of reversal. So very strong markets for me. I don't think we'll get a consolidation, but yes, what can happen is that because of the overbought situation on the intraday charts, you might get a day or two of pullback. So for me, that would be a wonderful buying opportunity. On the Nifty, the level is around 20,500. On the Bank Nifty, it's between 46,500 to about 46,400. I think if you get these levels, go aggressively long. You'll have to take a stop loss of about 1% or so on the indices. But I think this market will surely make higher highs in the coming few weeks.
Got it. Okay, all right. Good morning, gentlemen, and thanks for being with us today and over the last few years. Mitesh, you go first. Tell us some stock picks for the day.
Morning, Nigel. I have 3 buys to a sell today. HDFC Bank, we have had a recommendation last week as well. Last couple of sessions, it's been giving a pullback. So around 1620, 1625, a buy with a stop at 1604 and a target of 1660 can be looked at. A buy on IRCTC with a stop at 726 for targets of 770, and a buy on Wipro with a stop at 412 for targets of 430. One sell call, I think Cipla has had some kind of negative candlestick pattern and indicator set up yesterday. So that's a sell with a stop at 1221 for targets of 1165.
Sudarshan, what about you?
Well, it's all buying. I think this market deserves to be bought into whenever you can. Sun TV is a buy, and then I have ONGC where a buying opportunity exists. Finally, LIC Housing and Infosys. I'm not giving stops because the markets may be a little choppy. It's much easier to focus on positional trades rather than intraday. I'll just repeat it: Sun TV, ONGC, LIC Housing and Infosys.
All right, gentlemen, great speaking with both of you here. Thanks very much for those trades that set up. Chandan Taparia is also now with us to tell us on a derivative and technical side that what to do is, of course, with Motilal Oswal Financial Services. Chandan, good morning. Good to have you here today. Quick thoughts, Chandan. How's the setup? From a FII positioning in derivatives, they're now finally long some 23,000 contracts. Is there still enough comfort out there to go long, or should one wait for dips to go long?
Good morning, Prasant, Sonia, and entire team, and wishing happiest birthday to CNBC. Looking at the market, we have seen a tremendous rally in last couple of days. Nifty rallied by 1,000 points in no time. And if you look at the FI's long short ratio, that has recovered to 50%. Just a couple of weeks back, the ratio was below 10% or near to 10-12%. So recovery in the FI's long short ratio clearly indicates that they are big, and DIs are already participating along with the retail. So buying support led by short covering from FIs are the reason that why the market is inching upwards. And we believe, and because of that, buy on decline could continue. However, not expecting major decline, but every small support could be utilized for the next leg of rally. So looking at the same, we are suggesting to buy Nifty with any small decline with support of 20,700 and looking for a fresh leg of rally to us 21,250 level. Today's weekly expiry and 21,000 call writing is there. So because of that, it is finding some sort of consolidation. But till it holds about 20,700, expecting this run up to continue to us 21,250 and beyond. Now looking at the Bank Nifty index, yesterday we witnessed some profit booking, but major trend is intact. Buy on decline could continue. One can buy with support of 46,300, and finally we are expecting a move towards 47,250 in the banking index. Tomorrow we have RBI policy outcome, so because of that some volatility could be there, but till it holds the key support, we will continue to be with buy on decline in the banking index as well. Now looking at the stock wise, recommending to buy on L&T. Most of the capital goods stocks are doing well, and L&T has the strongest structure. Lower beta with sustained buying interest and put writing activity is clearly visible in the counter. It is continuously making higher top, higher bottom, which indicates momentum to extend towards 35.20. One can buy with support of 33.40 level. Second trading idea, there is buy on IRCTC. Most of the CPSE or public sector stocks are doing well. IRCTC is one of the strongest counter given the breakout, and the way it has formed a bullish candle with built up of long position indicates momentum towards 777. One can buy with support of 727. Last trading idea, there is buy on BSOP. We have seen good momentum in most of the IT counter on last trading session, including TCS, Infosys, and BSOP is one of the strongest counter, making higher top, higher bottom on the weekly. Supports are gradually shifting higher, respecting to key moving averages. So recommending to buy with support of 643, and BSOP can head towards 680, 685 levels.
All right, thanks a lot for that. Let's move on now. There's a big development that has happened in the media space. TV18 and E18 will be merging with Network 18, consolidating its TV and digital news assets. Network 18 merged entity will comprise of all TV digital news assets, that will be put under one umbrella itself. To discuss more on this and the impact that it would have, Karan Taurani, Senior Vice President Research Analyst Media at Elara Capital, is with us. Karan, morning. How have you read into this event and what does this mean for the listed stocks?
Hi, Sonia. First of all, wishing you all a very happy birthday to you and your team. In terms of potential impact, we believe that it really made sense to get all the businesses under one umbrella. What you are seeing right now is a very big disruption in the M&A industry because all the mediums of advertising are moving very aggressively towards digital. And there are very limited levers over there, in terms of monetization. And what this will do is that, you'll be able to cross-sell, you'll be able to appeal to a larger set of advertisers, you'll be able to bundle this entire offering around entertainment, content, everything put together, and even maybe charge a subscription fee, to the customer. So I think this is a clearly very good thing in terms of a revenue scale potential. You could also see a formation of maybe a media super app wherein the customer is kind of persuaded to pay for multiple services. And even in terms of the cost, there is a benefit here because you see merger synergies. You'll also see, cost benefits wherein a lot of the employee expenses, marketing expenses, the overlap will actually come down. So I think net, this should be a very good offering in a very fragmented digital market wherein most of the traditional companies are finding it very tough to scale up.
All right. Hi, Karan. Good morning, and thanks so much for joining in. You want to quantify the benefits, Karan? If you could tell us a rough envelope, back of the envelope, what kind of benefit could it be? And also, since we're going to be having both these two entities coming together, there'll be synergy benefits. Will it pose a bit of a challenge to some of the listed entities, or do you think the business perspective itself is very different?
So, Nigel, in terms of benefit, if you look at the number, as I say, across TV, print, and digital, the market size is about $18.5 billion today in India. And if you look at the TV and print segment over there, the growth rates are not more than about 3 to 4 odd %. And if you look at the digital segment, the growth rate is 15% plus on a CAGR basis. And, if you look at the revenue scale of the entire company, it's not more than about $1 to $1.2 billion. And the market opportunity is about $18.5 billion. So I think, going to market together will lead to better growth rate, better market share across, these various categories which are there. So you could actually see superior growth rate, for this company as a whole. And also in terms of cost and benefit, what happens is that you've got multiple apps that you maintain. You've got some print app, news app, you've got some, business news app, you've got some kind of Geo Cinema app. So a lot of the costs, could be shared here, specifically the costs, which are very high in nature in the form of marketing costs, customer acquisition costs, employee costs. So that kind of benefit will also kind of give a fillip to the overall EBITDA margin of the merged co. And lastly, in terms of the potential impact for the broadcasters, we don't think that, this is a negative impact as such for Zee and Sun TV, because both those broadcasters are not based on news. They are more based on GEC kind of offering. So there's no impact on that for now. But this could have a potential impact on TV Today, which is a news-based broadcaster. And they've also got a lot of digital assets on the print and the business side.
So what do you do with the stocks now? Just to summarize everything, what is your view on the listed entities?
So I think, in terms of valuations, if you see, the valuations are not cheap. So, just broader numbers, I think on an EV/EBITDA multiple basis, they would already be trading at somewhere close to more than 20 times on a forward EV/EBITDA. If we assume a very strong growth and if you assume some kind of synergy benefits herein. So there is not much of an upside from current levels, but, potentially, one can look at this company from a digital company standpoint. And if you look at digital, that's the growth driver nowadays. I mean, 15 to 20% growth is, happening in that segment. So if one were to look at this as a digital first company, you would value it as an EV sales basis. And that's when you'll probably see some kind of delta emerging over the medium to long term. But that really depends in terms of, how they actually bring everything under one umbrella. How are they able to cross-sell, upsell? How are they able to target a large set of advertisers? How big can the entire opportunity become in terms of scale and advertising? And can they actually charge the customers a subscription fee? So a lot of monitorables are there, for the valuations to move up from here on.
All right, Karan, thanks a lot for joining in. And folks, we are here celebrating our 25th birthday on CNBC TV18, all ready to ring the bell. I have the entire team behind the scenes, all the guys who do all the hard work. So it's birthday celebrations for everyone here on CNBC TV18 and the most important person, our viewer, because of whom we are all here today. So thank you once again. I think we have, about 10 seconds left?
Yeah, let's go for the countdown.
20 seconds left
20
before
seconds.
the markets open. And it has been such a rocking ride, right? Not just CNBC celebrating 25 years, but the equity cult really strong, all-time highs for the market. So a great day to celebrate.
Sridhar Shivaram is also with us.
Sridhar is right here with us.
Thanks very much for joining us.
Thank you.
Let's go.
Okay,
5, 4, 3, 2, 1.
And there you have it. You want to go for it? Go for it, Arshad.
You guys. Not my take.
Go, sir.
Come on, Nigel. Go for it. Right, and there you have it, the opening bell.
Longer.
I think we can put some music to the commentary, right?
Well, it's the party, Manglam. Ring it.
It is the party.
Well, I think we've got markets which have opened, 60 points lower, 60 points lower, and things are looking, the opening wall will come up on your screen just to give you an indication. But as Sonia was saying, right in the morning at 8 o'clock, this is the team, if you can see it behind us, around us, which basically puts the entire show on it every single day.
And, we have Sridhar also here with us. Sridhar, thank you for joining us. Great time to be in the market.
Of course.
All-time highs. How are you feeling about it?
No, actually, I want to take some perspective. That 25 years, I started in 93. There was no CNBC then, and we used to call up the ring to get the prizes. These were the dinosaur days. And from there, when CNBC came, it was a big change for people like us because we used to get regular commentary, the ticker. There's been a huge change in how we've been investing, say, 30 years back to when it was post-CNBC. So a big thanks to CNBC for all the effort that you guys have done to bring about corporate governance changes in the market by asking difficult questions to companies. And I think it's a great credit to the entire team of CNBC for what you've done for the markets in general. That's how I would say.
Well, Sridhar, how are you feeling about the markets, though? We are definitely in celebration mood because it's our birthday. And the markets, well, we're on our way to 21,000 odd. What do you think? Are we getting a little bit ahead of ourselves?
No, I think, once the election results were behind us, it's reasonably clear that now we get one more term. If you ask me, my confidence level of 300 plus for BJP now goes up from say earlier 60% to now maybe 80-85%.
Yeah.
So basically the market likes continuity in governance because of the reforms that this government has conducted. I think that helps a lot in terms of how the markets will move from here to May and beyond. So I think the party will continue from here on. So I think the market will climb all walls of worries. Only big worry is the US inflation and the rates. Otherwise, domestically, we are broadly set for a big rally from here on.
Just one more query. You know, I always say that I'm keeping my SIPs going, but I'll personally as well, I have to tell you that I've been adding some gold as well, you know, in the last 10 days or so. And you have been, you know, a strong advocate that gold will do well over a longer duration as well.
So I've always maintained that the Indian woman is the best fund manager. Beat her returns and show me, and I'm a fund manager myself. I was just looking at the number, 20-year returns, Sensex and gold, both at 14.3, 14.4. I'm talking of 20-year returns for gold and for the Sensex. They're exactly the same. 1-year returns, also the same, roughly 14-15%. So I always say, Indian women, they're the best fund managers. Beat her returns and show me we do so much work for this 14% return. Watch CNBC, look at balance sheet, analyze, and the Indian lady just buys gold.
I love the watch CNBC. Is there a bit of South Indian thing, South Indian love for gold here as well? No, that's not.
No, I think all women love gold. Yeah. I mean, this is
no, I'm talking about you.
No, I don't buy the physical gold. I buy the digital gold.
And these returns are rupee, gold and rupee terms.
Returns. So which is what I always say, that it's actually also the currency which. So it's a hedge against the currency.
Yes.
So the currency depreciates about 4-5% a year, and this is the best hedge against the currency. Having said that, I think equity has also given the return, so it is not.
Just one question. A lot of people want to know what from here, because the market has done so much. It's been a big step up in the last 6 or 7 days. Can this continue all the way into the general elections? Will we see a rally like what we saw late 2013 into the general elections in 2014?
I think it's exactly like 13-14, because 13 had taper tantrum, and then you had the election results. And there were a lot of other global worries, but the market continued to, climb all the wall of worries. I think we'll see the same this time again, because FIs are so underinvested in India that we will see a shift from other emerging markets to India, and we'll see this market rally through up to May and beyond, is my view.
10, 15%, 20, what
honestly,
numbers
I don't know.
Broadly, what kind of a rally? A meaningful rally, right?
History suggests more than 10%.
No, I would say that we should continue with the returns that we've given in the last 20 years, which is like if we can compound 14-15% over the next 5 years, you're talking of doubling from here in like 4 years then, roughly, So I think that's a great number. You're talking of almost 42,000 Nifty. So by the end of the decade, we'll be close to say 55,000
on the Nifty. Wow. Okay.
So,
there was one space that you were really bullish on, which is PSUs, right?
Yes.
It was. I remember having this discussion with you, I think a year and a half ago.
21 February.
Yes, and since then the PSU banks have rallied substantially, and PSUs in general. Now they've come back once again. Under that umbrella, where do you still see value?
So I think, Sonia, every decade we see a regime. So if you go back to the previous decade, the regime was high growth, high P stocks. And that extended to such an extent that it was just high P, the E disappeared at some point of time. I think the regime has again changed. Something happened post 21, and the market has gravitated towards value to some extent. And fortunately, these value stocks also have started to return earnings now. So if you see the last 3 years, the best performing sector is PSUs, which is giving you a 50% CAGR. And the PSU banks also 50% CAGR. And the next one is like 20% below, if you look at any other sector. So obviously something has changed. And this is what I tell people, that when I look at some of the banks now, even after say 4 times, they've gone up 4 times, they're trading at 5p, 6p. You can still argue that, it can double from here, and still you can justify the value. I mean, I was just reading a report on the OMCs. I mean, if the numbers are right, they're trading at 5p, 6p.
Right.
So I'm not suggesting that you should buy or sell. I'm just saying that we are at an early stage of this, because the starting point was so low that even after this spectacular rally, you can easily justify that if I give you know, 10, 15, 20p for other sectors.
You can give maybe double-digit
You can
Ps.
give double digits. I'm not suggesting that you go and buy any of these.
No.
I mean, every individual takes his own call. We remain bullish on this segment. We think that the regime has changed. One last point, if you look at the top 10 Nifty for this year, there are 5 PSUs in there.
Yes.
And there are 3 auto stocks in there, which you know very well.
But my question was more towards the PSUs is a big basket. There are defense PSUs, there are power PSUs, there are banking PSUs. Where do you pick? Where do you pick from?
So, Sonia, that is the skill of the fund manager.
Let me just
right?
add to that.
Sure.
I think there is a PSCB's product, right?
Yeah.
So instead of choosing for viewers who are watching, does it make sense
fund.
to buy a
In fact,
basket?
You go back to the 21 interview I gave, I had suggested that there are 2 PSU mutual funds.
Yes.
So for a retail investor, in my view, that is the best option. There's a SBI mutual fund and there is an Invesco PSU mutual fund. In fact, I was looking at it yesterday. The AUM is only 800 crores.
Wow.
I'm like, after 50% CAGR return, even now people are so skeptical. So that exactly tells me that nobody believes in this story. And I was actually so happy. There's a fund manager who comes on your show, I don't want to name, who is from Singapore, comes regularly on your show. He recently added 3 PSUs in his portfolio. And for someone who's always said, I'll never buy PSUs, I was happy to see that there's a change. A slow one, but there's a change. I think there's a lot of denial. And I think a lot has changed in the PSUs. I think the governance has changed, the business model has changed. Yeah. The stress from the government that you have to be profitable has changed, barring a few segments where they have their own issues. But I think this is a basket. I think the entire value basket is worth watching. So I think when regime changes, it is not like others will not perform. The other segments will also perform, but there will be a leader. If you ask me, possibly the leader is PSUs. I could be totally wrong, okay? But looking at the early, indications, when a regime changes, it changes for at least 10 years.
I think that's very useful advice. The mutual fund route, buy a basket instead of trying to pick this or that.
Even what you suggested is also an option. But I'm just saying that it's better to buy a basket rather than, betting on individual stock, because that is a skill that we have. May not be possible for an individual investor to, pick and choose. Because as you said, some of them are trading at 2p, some of them are trading at 50p also in the PSU basket. So it is not a homogeneous set anymore because they have rallied 50% CAGR. I mean, that's a massive number.
So SBI and Invesco are the 2 mutual funds you spoke about.
The 2 mutual funds who have, and the AUMs are so low. I mean, I'm shocked. I don't even think they are marketing. I mean, it can't be that after 50% CAGR you have only...
I mean, actually, even when you buy funds nowadays, the challenge is funds are now 30,000 crores, 35,000 crores to find something where AUM is 800 crores. I mean, that's a rarity.
I invested in a children's mutual fund and I thought the AUM is only 1,000 crores. So this has the potential in the next 10 years is going to be big returns. I missed out on this PSU mutual fund, so I'll go ahead.
You didn't see the show I did in 21.
I'm going to do that. But we have gone on enough about the PSUs. Sridhar, I want to ask about the backbone of the market, which is the banking names. And the larger banks, they have been big underperformers.
Yes.
Do you think the time has come, if you're looking at the banking space, yes, put some money in PSU banks, but some of these large private sector banks that have actually underperformed, is it time for them to come, take strike and maybe perform in line?
100%. So we are very bullish on the private banking space. See, they've had some challenges because of how the interest rates have moved. Deposit costs have continued to go up. Look at RBI's commentary, they have been tightening liquidity. So I think some of the headwinds for the banks are there. But I think some of these private banks have managed these risks many years now. I think they are very well positioned to, move from here. Their profitability will also move from here significantly because credit cost is not going up, even though there are some risks like RBI has been, flagging the risk, and rightly so, which is on the unsecured personal loans. We remain quite bullish. We think that the underperformance that they've had was for the right reason. But from here on, this looks like a segment. And the other thing is when FIIs do come back, we are seeing early signs of that. This becomes an easy segment to enter. So I'm quite bullish on that segment.
I'm having a conversation with another fund manager. They said, Nigel, since you like cricket so much, it appears these private sector banks, they got their eye in, now they're seeing the ball and now they're going to perform from here on because they've got their eye in, after a long time of underperformance.
I would agree with you. So there are different baskets, different ways of reaching your goal, right? If your goal is to get 15%, there are different ways you can buy PSUs, you can buy private sector. I'm not suggesting that the other components in the market will not do well. And when there's a bull market, all components do well.
Tend
As
to
they say,
perform
rising
well.
tides,
Absolutely,
it takes up all the
Indeed.
boat. But there'll be some leader, and possibly that's how I'm positioning
Okay,
myself.
Sridhar, since we're celebrating 25 years, before we wrap up, if you had to give one piece of advice to your 25-year-old self, what would it be?
Which is to have invested early, do a SIP. We didn't have SIP at that time. If I tell my daughter, who was like 22, my son who's 26, that invest every month from your salary, because the earlier you start, the corpus that you build by the time you are, say, 30, 40 is so huge. And the power of compounding, we just don't realize that it is so huge that if you are going to compound your money at 15% for 10 years, that's a massive number that it becomes the corpus that you build at the end of, say, 10 years. And that corpus then compounds at another 14% if you stay invested in the market. And I have no reason to believe that what we've done in the past 20 years, we should actually do even better, because I think maybe the next 10, 15 years will be the great years, because as we move from 2,500 per capita to, say, $5,000, typically markets give disproportionate returns. You look at what happened to China, or see Korea or Taiwan, and see what happened to their markets when their per capita moved from $2,500 to $5,000. They all gave outsized returns. So I would want to bet that we will follow the same path. We'll give outsized returns. And so this is the time to stay invested and not worry about the timing of the market.
All right, time in the market, not timing in the market.
Yes.
Well put, Sridhar. Stay with us. You were talking about a fund manager from Singapore, right?
I'm not
we
going to
actually have a fund manager from Singapore.
He joins us very frequently, by the way.
I'm not going to comment on
Samir
that.
Arora is with us. He's, of course, the main man at Helios. Samir, great to have you with us here on this momentous date. We're celebrating 25 years of CNBC. And sorry, we can't hear you. Go on.
Oh, we
I was very happy to see Sridhar saying that if the markets are up, everything is up, including PSUs.
No, are you the fund manager from Singapore? Samir, if you heard Sridhar earlier.
I am not the mutual fund manager, but broadly we also have many of those same stocks. But the point is that we have our fund, and me personally, we are the flexible fund managers. So at various points when it didn't justify, it did not was not in the portfolio, these PSU stocks, some of them still are. But anyway, I still don't agree with this painting the brush that something has changed. If Sridhar can explain to me the difference between, say, I don't even know whether it's listed or not, Bank of Maharashtra and Central Bank, and which one has anything other than price to book is 0.4 and 0.42, I would be very surprised that anybody knows that. So beyond a point, we cannot buy stocks based on some price to book arguments, because in many of them, we don't even know why they exist. What is the difference between one and the other? What app they have, what millennium crowd they have, what is it other than price to book, price to book. So it is up to a point is right that in some sectors, the PSU leaders are leading, but it is not that buy PSU baskets and buy everything. I will not agree with that. But
All right, let me just, Sridhar can't hear you, but Samir can hear Sridhar. So let's just continue this conversation for a bit longer.
Sure.
Samir was essentially saying, sorry, say that again, Samir.
First, I have to wish you a happy birthday.
Please do that. Please do that properly.
Yes. Happy birthday and best wishes. I've been there from day one, I think, or maybe even before you guys were formally called CNBC-TV18.
No.
So I've been there all along.
Thank you so much, and thank you so much for being sort of there every time we call you, for your expertise, for your views, and I think you've been a strong guidepost for us in our markets coverage over the last 2.5 decades or so. Just to kind of complete that loop on PSU Bank, Samir is saying he's not impressed with the PSU rally.
So listen, I have great respect for Samir.
One minute. He go on. Samir, say that. I'll convey it.
I didn't say that. I am saying the basket, if you at one point say that since this is a rising market, everything is going up, that also includes PSU stocks. I was saying that between the 5th and the 6th PSU bank, what is the difference other than saying that their price to book is point something? What is the management? What is the strategy? What is the app? What is the technology? Nobody knows. For the top 1 or 2, which we have had forever, like State Bank, we've had since 2020, June or something. I know what it does. I know what its technologies. I know what its strengths are. I'm saying between the tail. In the tail, we don't know what it means, and we can't buy it off a price to book kind of number.
Okay, got it. Samir, First of all, thank you for your wishes and thank you for being here through thick and thin with CNBC TV18. I mean, it's been a pleasure watching you, listening to you, learning from you. But, you know, I mean, we were just having this discussion with Sridhar as well as to what would that advice be you would give your 25-year-old self. And he said, you know, I would tell my 25-year-old self to invest, start investing earlier. But now we've reached a phase where this new generation, right, we have the largest Gen Z population in the world. This new generation is very savvy about investing. So they know a lot more than the previous generation did. So what would your advice to them be?
I totally disagree with that. I think they know much less than we used to know because they don't read books. They only do options. They only do futures. And every day, because I am, you know, active on Twitter, even in terms of reading Twitter, not just writing on Twitter, every day one fellow will say, I bought this stock because this thing happened. That guy bought because I saw insider buying. So on one factor they are buying. And those factors are working right now because there is a bull run going on for the last 2-3 years in all these stocks, which you can buy with one factor. I bought this stock because yesterday the management bought. I bought this stock yesterday because it disclosed something higher than you see on Twitter. Every day, the total logic of the buying is one line, at least the way they present it. And so I think that they are taking it too casually. Yesterday, I heard somebody writing that his client said that he'll be happy with only 50% returns per annum and things like that. So according to me, they should read books much more than we did, although we also read and Sridhar and all. We were all, you know, readers and are readers. There are many things I think they know less, but they shall learn over time. There is no free lunch in this business. Either you spend time or you spend effort. You can't just do two-line research and buy things.
All right. Hi, Samir. Good morning. Nigel on this side, and thanks so much for joining in. Samir, the last time we spoke, you know, you were saying that in case there's an adverse outcome on the 2024 elections, well, the markets could see a fair bit of selling or, you know, could see some bit of downside. That it appears now that kind of uncertainty has been brushed aside, at least for now, going by the state elections. Are you feeling much better from here on? With regard to
No. I was feeling better then also because I answered the question that you asked. You did not ask me the probability of that event. You said if it happens. The thing in our business is that if we say that two things can happen, it does not mean that the probability is 50-50.
So you were anyways
5-10% theoretical probability that if something goes wrong, you will lose. You can't say no, market would have discounted it in 1 minute. That's what I'm saying. But I was always confident. We are running with 75-78% net well before this outcome, because you know that the probability of the event is less, but in case it happens, it is bad for the market.
Okay.
So this is not changing that, but obviously you can say that it is easier now to tell particularly foreign investors sitting on the sideline that, hey, don't waste your time ticking the last box that whether there is political certainty or not. It is sort of already there. And if you want to wait, here, see this one, you've lost another, say, 3%, 4%, whatever. So it helps in that, and therefore it sort of feeds on itself.
Samir, you speak with a lot of foreign fund managers. Are they going to come in full force in 2024? Because, where the markets have reached now, locals have done it without very much help from FIIs. Now, of course, we got to wait for the foreigners. What's your sense?
So I don't speak to foreign fund managers. I speak to foreign allocator. You can say that there is a fund or somebody or the other. 100% they will come, 100%. But the thing is, it is not surprising because they have always come, except in a few bad years, 4 bad years particularly. Last being 22, and then before that 18, and before that 11, and before that 8. But other periods, every year, FIIs have bought because they also have growth in their AUM because of worldwide growth, some allocation from this sovereign, this, that, whatever. Now the question is whether it will be in full force. The reason for it being in full force might be because of their losing a lot of money and confidence in China. So if that reallocation happens, then the force becomes a real big force. Otherwise, anyway, they should be not net buyers, even in normal situations.
So
now the difference is, there's a domestic buyer against it. So if both buy, then is where the fun starts, which is sort of we are all playing for.
The good part, Samir, is that large caps have not outperformed the market, right? Have not done anything actually this year. Most of them, Reliance, HDFC, Kotak, etc. Do you think that 2024 is a year when large caps will start to perform in a big way?
So we are betting that large cap financials will definitely perform in a big way because financials are otherwise doing well. And their stocks have not gone up and they are a large part of the market. So even if the foreign investor wants to be underweight, overweight, if he's starting off a 30% weight, he could be 25 or he could be 20 or 35, but he still has to put in substantial absolute amount of dollars into these stocks. For the other two groups, which according to me are IT, Reliance is one, but if I talk otherwise, it's IT, consumer and financial, which are the three large groups or large companies. IT sector, according to me, is still doing quite badly.
Okay.
And therefore, I don't think they will get the same amount of interest from foreign investors as financials. And consumer always looks a bit more expensive to anybody who comes in. Who's coming in fresh now would think that, was he waiting for this long to buy something at 40 and 50p and all that? So therefore, they could buy Reliance or they could buy the financials, is my guess.
All right, Samir, so, in the next, say, 12, 18 months, do you expect HDFC Bank to outperform from here? It's been underperforming. You have, on the valuation parameter, if the FI flows come back, and if you like financials, that's the one that normally everyone would go to. So do you believe that the next 12 months will be much better?
That is absolutely right. And according to me, it is putting a cap on other stocks also. So when HDFC Bank does well, then only the other stocks will. Because even today, you can't have many bank stocks trading at premium to HDFC Bank so easily because of the long history of the bank and it doing well. That is our bet. It is our number one holding in every fund that we have.
All right. Well, Samir and Sridhar, thank you so much for joining us. Thank you for being a part of our celebrations today. And all the best. This is promising to be a very good year. Not just 2023, but 2024 to come, right? With the elections, so many big triggers. So thank you both for joining in. Well, let's do one thing. Let's take a quick commercial break. On the other side of the break, it's CNBC-TV18's 25th birthday this week. Entire week, we have been speaking to a whole host of top management. So in a bit, when we come back, we will have the management of Mahindra & Mahindra, a stock that has generated huge wealth for its shareholders. Rajesh Jajurikar, the head of Mahindra & Mahindra, will be joining in to tell us how business is shaping up so far. Stay with us.
Congratulations to CNBC, and you guys are the gold standard when it comes to business reporting. So I'm glad to be here and wish you guys another very successful 25 years from here on.
Embarking on a quarter century of excellence.
Okay, welcome back. You got the market, which is down 50 points right now. Just taking stock of where we are at about 20,888. And maybe just a run through of some of the big movers that we've had so far. Top of the list, and I'm going to start with gainers. The Adani Group stocks are still flying high. Adani Energy Solutions, which is the erstwhile Adani Transmission, that is up 5%. Adani Green is up 7%. Adani Total is up 10%. That part does very, very well once again. Tata Power is doing well. Power as a theme actually has done very well, 3.5% on Tata Power. Patanjali is up about 3%. There was an analyst day, I think yesterday. Sterling and Wilson Solar has been moving up 5%. Circuit is up another 3.5%. KEI Industries is up about 4% or so. There is GIC RE, which is up another 5.5%. Inox Green is up 3% and so on and so forth. And just a run through of the big losers, my God, look at Paytm. That's a 15% cut coming through on Paytm. We were highlighting earlier this morning with Abhishek, some of the downgrades, etc., which have come through. And this is the risk on the day when that RBI increased risk weights. People like Jairam Sridharan of Piramal had highlighted, smaller ticket size loans basically will be the ones which will be hit the most. And, fintechs, etc., for everything that they do, the bulk of the money is made on lending. And with this coming under a bit of pressure, I think the market is reassessing prospects here. Lever is down 2%. Maybe just take a quick look at that. IDFC First Bank is down about 3%. Ircon, Balrampur Chini, I think lost about 7% yesterday. It's up another 7%, is down another 7% right now. Stocks at about 403. AB Capital is down about 6% as well. So there are some pretty large moves, both on the upside and downside as well, as we begin this Wednesday's trading session. The Nifty with about a 50-odd point cut. It's a small cut, small pullback after the 1,000-point move that we've had over the last 6 days. Sonia.
Absolutely. So let's welcome our first corporate guest on board, Rajesh Jajurikar, who is the Executive Director and CEO of the Auto and Farm sector at Mahindra & Mahindra, joins in now. Rajesh, thank you as always for joining in, especially on a day like today where we celebrate 25 years of business news excellence at CNBC-TV18, and you've been a large stakeholder of that journey. So thank you for being with us. And it's been, of course, so many years of excellence at M&M as well. As I spoke about earlier, so many years of wealth creation. How are you feeling about the couple of years to come, and what's the big vision at your end?
Sonia, Prashant, Nigel, firstly, congratulations to all of you CNBC TV18 teams for what you've accomplished. And the 25th anniversary is, of course, something very special. So it's, real privilege to be with all of you here today on this very, very important milestone that you've accomplished. And I was just wondering what you're going to be doing differently on our 25th anniversary. One is, you get all of us to chat with you, but is there anything you're doing differently?
Well,
sorry, I'm flipping this back on you.
For one thing, we went and we rang the bell, in our newsroom. We had an entire newsroom here with us. So that's something we did differently. But, I'm glad you brought this point out. Cool. Because in order to stay relevant, right, over decades, especially in this digital era, you need to do a lot of things differently. And I know that M&M is doing a lot of things differently as well, especially with all of your new launches. But you tell us, what's the best way to do this?
Well, like you said, it's we all have to be very excellence-driven in everything that you do, and that's really the way you positioned your 25 years, and that's the way we position our business, because we believe success is going to come out of doing things really well, raising the bar at every stage, and that's what we're trying to do with our new products, and products and experiences is really what drives value creation. So we are focused on our part of the role, which is bringing exciting products. We brought some really good products on the tractor side. Oja more recently under the Mahindra brand, very tech loaded. We've got Swaraj Target, which is a lightweight tractor, the whole new Swaraj range with the Dhoni, with Mahendra Singh Dhoni as the brand ambassador. And of course, some very exciting SUVs. Our pickups have been doing very well, and last mile mobility electric. So, it's been an exciting time. And really, like you said, celebration should be around excellence.
Okay. Since you're talking about numbers, right, let's get it to the brass tacks numbers. This month in November, the wholesale sales were up 20%. And that's not a small achievement. 20% month over month for the last many months is something that is perhaps hard to sustain, especially in this competitive environment. I just want to understand that, is it going to continue continuously be led by the growth in SUVs? Because you are putting some capex on board as well. Your SUV production will go up. What is the kind of numbers that you're looking to achieve over the next couple of months?
Can't give you specific numbers, but just to break up the numbers that you spoke about, the SUVs grew 32% in November. So, we did a volume of close to 40,000, and that was a 32% growth. Pickups, which is on a very large base, and in the less than 3.5 5-ton light commercial vehicle category, we have a very strong market share. We are, in the range of 48, 49%. So very strong market share. We've gained 4-5 share points. There we grew 13%. So that's very credible on a strong, on an already high base. Overall, I think these are very good numbers. To your specific point on, how will we sustain momentum? In this business, it is about, especially in the auto side, about new products. So we would have some new products on the ICE, and then the whole electric portfolio, which will come in early 2025. So we believe that will help open up a new category of customers, people who are looking for exciting design, technology, and a whole totally new driving experience, which comes out of the very quiet electric powertrains and very peppy, very powerful, very fast. So, we believe that's what will drive future, and that, connects to your point on driving excellence.
Rajesh, hi, good morning. Thanks for joining in. Prashant here. Let me just sort of take this towards
Prashant,
tractors.
Hi, morning.
Hi. Nice to see you, Rajesh, as always. On a year-to-date basis, tractor sales are a little subdued, right? But we are getting into the election season. Typically, what happens ahead of general elections? I mean, there is more money in the system, that is for sure. Should we expect a better outlook over the next, say, 2 quarters or so?
That's Prashant, actually a very interesting question. So 2 things happen around elections. One is, you're right that typically spending in rural does go up, but the election period itself is not a great buying period, because very large chunk of people are engaged around election campaigning. So the election months and the lead in into that, normally in those states or whatever, is normally a little bit of a slow time, but that catches up later. It's like people are postponing to a time when they have a little more time to go and evaluate and buy products. But of course, this year the tractor industry is slow. We were anticipating that. We had started by saying low single digits. More recently, we are saying it will be flattish for the industry for the year. We have gained market share again about over 1 share point, and we have been showing some growth as a consequence of that. In November we grew 4.7%. What is leading to a slowdown? I think it's been a little bit around the monsoon timing. Some of the states in the south haven't really had very good rainfall, but it's also a very high base out of the past year. Last year, the tractor industry was at 950,000, which is a very, very large industry size. And we were expecting that, on a high base, there will be some kind of a tapering off for a year or so.
Hi, Rajesh. Hi, Rajesh. Nigel on this side. Rajesh, first of all, congratulations to you and team as well with regard to the kind of launches you have done the last few years. I don't think I've ever got so many requests that can you speak to the management to get our delivery on time, because there's so much of demand for some of the vehicles that you all have launched. But the next phase of growth is going to be the EV space. Tell us about the rollout plans out there. I think you have 4 or 5 launches planned in the next 3 or 4 years. So tell us, when do we see the first EV and how do you expect that to ramp up?
Yeah, so we've really put out, unlike what we do in the past, the whole portfolio of products. The first vehicle or 2 out of that will happen in early 2025. Production would start in 2024, but we would get it to market in early 2025. We're very excited about the way they're coming. They're testing very well. They've run more than 300,000 kilometers already on the tracks cumulatively. Several vehicles running on our tracks, and they're performing very well, and we're benchmarking them with the best in the world. So they would be a very exciting portfolio of products. Of course, many of you have seen the design. They are really, really striking, strong, powerful designs, and but there's much more to it than just the design. So wait and watch that space.
Okay, that's on the EV space. I just wanted one thought from your end on the operational performance. I know you won't want to give me any numbers, but if you look at the margins, right, you map the margins over the last 5 to 6 quarters, you've stayed in that range of around 12 to 13.5%. Now that you're getting into, over the next couple of years, getting into the electric vehicle space, SUVs are doing very well, tractors are coming back. Is there scope for your margin profile to rise above this 12-13% mark?
Yeah, Sonia, so, when we talk about margins, we often kind of guide that when you look at a total margin, it's not really representative because we have two different businesses with different margin profiles. There's an auto business which has gained a lot of margin. It's now, as you saw in the last quarter numbers, we've got to 7.9% for our auto business. The tractor margins are, we say typically, we believe is a good margin in the range of, for our core tractor business, between 17 to 19%. We are in that region. But as the auto portfolio is becoming stronger and growing very fast, the weightage of margin is bound to be affected because auto is, which is growing much faster at the moment, is on a 7.9% margin profile. And when you compare that with farm, which is on a 17% margin profile, obviously the weighted margin is going to come down as auto grows faster than farm. Does that help answer the question? So I think we are basically growing auto margins very well. Farm margins, are flattish given the nature of the industry, but we often say that irrespective of what's happening in the industry, the tractor margins operate within the range of 17 to 19%, which has really been our strength.
All right, Rajesh, we'll leave it there. Thank you so much for joining us here on this special day and speaking with us here. Thank you very much. And thanks for all the support over the years and look forward to more.
Pleasure. And have a great week of celebration, all of you.
Thank you. Will do. Appreciate it. Well, let's move on from one top management to another top management. Dinesh Khara is chairman of the country's largest bank, State Bank of India. Let's get chatting with Mr. Khara about, of course, the implications of the increase in risk weights that the RBI implemented. Some of what we are only starting to understand now, like in the case of this sharp fall that we're seeing in Paytm. But first of all, Mr. Khara, great to have you with us here on CNBC. Prashant this side. We're celebrating 25 years here at CNBC. So thank you very much for your support all these years, sir.
Thank you very much, and all the very best to CNBC also.
Thank you so much, sir. I just want to begin there, what I said earlier, which is some of this, the risk weight increase trickling through. We spoke with you earlier, we've spoken with others as well, and the general understanding is that the smaller ticket size loans, under 50,000 rupee loans on the unsecured side, that is essentially going to see a big slowdown. Is that your understanding as well? And I mean, if you can kind of explain that to us.
Sure, I think there is a lot of anxiety on this particular RBI guidance in terms of RWA. But the way I look at it is that this is actually applicable only to consumer loans in general, but for housing loan, education loan, vehicle loans, and loans secured by gold and jewelry. When you mentioned about low ticket loan, many of them are the loan against gold and gold jewelry also. So the general belief that that there'll be a slowdown in the loans and the low ticket value, it may or may not really happen. So if at all we exclude these, we filter out these exclusions from the consumer credit, we observe that the consumer credit has been growing at about 25% plus since May 22. And the share of these loans, which are actually impacted by RBI norms, is just about 15 trillion on a total loan base of about 151 trillion of the banking system. So in all about, it is about 9.8 to 10% as on September 23. So if we look at the impacted portion of the personal loan category, I don't really expect that it will have a significant impact.
Okay.
The other piece which I may share with you, that the banking system overall are holding about excess capital to the tune of about 7 trillion. And when we evaluated the impact of these higher RWAs, it will consume only about 84,000 crore worth of capital from the banking system. So in all, about 0.70% is the overall consumption of the capital for this particular piece. So I think for all purposes, I perceive it to be a non-event.
Okay, got it. I mean, from a banking, but absolutely. I mean, there's excess capital in the system and the implication will be small. But as the country's largest banker, sir, you've got a bird's eye view of which segments are accelerating, where perhaps there is trouble fermenting, etc. Specifically for fintechs, what is your view, Mr. Khara, who were, the business model for many was, of course, built around building out the lending business. Are the concerns and what the RBI has done a bit of a body blow there, or you don't believe so for that segment, for fintechs?
I think agnostic to fintech or otherwise, the way I look at it is that if at all the lending entity have got a system in place for understanding the credit profile of the borrower, and they are mindful of the risk which they are undertaking, I think that is something which is very critical, whether it is small value, low value, high value, whatever it is. But very important is underwriting standards and also the collection mechanisms. What is actually was probably a worrying area was this excessive BNPL which was seen, where simply on looking at a particular transaction, the offers were being made for offering the credit. That is something which is a matter of concern. And I think that particular segment of the business might get affected. But other than that, I perceive that it should not have any significant impact overall.
Hi, Mr. Khara. Good morning, and thanks so much for joining in. Nigel on this side. Well, I wanted to ask you about the other piece of news then. How much of your lending, how much of your loan book is towards NBFCs? If you could give it to us in percentage terms.
NBFC exposure should be, we have got a loan book about 36 trillion, 36 trillion. So on that, it would be somewhere around 8-9%. And it would actually involve some of the public sector sponsored NBFCs like, the AAA rated NBFCs also. Significant portion of that is, of this NBFC book is essentially those NBFCs or the NBFCs which are supported by leading groups, and they are very well managed also.
Okay. Mr. Khara,
small NBFCs composition would be very, very small.
Okay, got it. Mr. Khara, good morning and thank you for being with us on the channel. I just wanted to talk a little bit about growth as well. What kind of loan growth do you see, not just for yourself but for the industry overall? Which are the pockets that are picking up now, both in terms of corporate as well as retail loans, and overall, what's your vision for both FY24 and 25?
Well, as far as the loan growth is concerned, we are seeing a lot of interest coming in from the rural and semi-urban space also. So actually, corporate, we do get to see the positive trends as far as the renewable is concerned, and as far as EVs are concerned, and even the conventional steel, cement. So all these areas we are seeing good traction. So I think corporate book also, we expect that this quarter we should get to see much better growth even in the corporate sector also. And the SME space is witnessing a decent growth. And apart from that, I would say that as far as the retail is concerned, that will continue to see the very strong growth, including the home loans and the real estate. Actually, home loans, essentially home loans are seeing decent growth. I would just give you some kind of a comparative. As far as the housing is concerned, for the system as a whole, as compared to about 9%, it has grown very well. From April to October, it is somewhere around 25-26% growth is seen. So I would say that this is a very promising sector, and this also leads to growth in all the core sectors of the economy. Though infrastructure is more or less at the same level where it was in the previous year for the system as a whole. But this is the other area which is going to see growth. And I think I would say that rural, SME and corporate also will get to see a reasonably decent growth.
Okay. So when you talk about decent growth, what are the numbers that you're looking at? And also, what does this mean in terms of the asset quality for the bank?
Well, as far as we expect that the system should be growing in the range of about 16 to 18%.
Okay. That's for FY24, is it?
That's right. That's right.
Okay, and what are we looking at for industry growth in FY25? Would it be in the 16 to 18% range or better?
I would say that this is a function of how the real economy works, and the early trends which are seen as of now for the year 24-25 are also quite encouraging. So I think with that in mind, my expectation would be that though it is too early to predict what is the likely growth in the year 24-25, but my normal expectation would be that it should be in the similar range.
All right, Mr. Khara, we'll leave it at that. Thank you so much for joining us. Appreciate your time here on CNBC-TV18. Let's slip into a quick break on that note. On the other side of the break, Mitesh will be joining us for a technical check on the markets. Very quiet, really, the start of the market today, just consolidating around that 20,500 mark. But more on the markets in a bit. Stay tuned.
I would like to congratulate the entire CNBC TV18 team for completing 25 years in the Indian news industry. It has been the channel of the business channel of the choice.
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. Well, the market's a little bit under pressure. The good news, though, is you still have more number of stocks that are advancing in comparison to the number of stocks that are declining. So the crisscross line should come up for you on the screen. Mitesh Thakkar is back with us. Well, Mitesh, what do you make of this morning's trading session? After a while, in the first half, we're down closer around 70 points. Would you be looking to buy into this dip? And particularly on the Nifty Bank, from around that 47,000 mark, we've come down to around 46,500. Where does support come in at?
Morning again, Nigel. I think while the Nifty, has come off a bit, but I think it is the Bank Nifty which has come into the buying zone for me. 46,500 was my support area, and I think the low which we've got today is around those levels, 46,507. So we have bought some quantity, not a very aggressive one. I think once we see a reversal on the hourly charts, we'll add more to long positions. But yeah, I think around 46,500 buy with a 300 point kind of a stop at 46,200. I do believe that there's a good chance of us not only retesting the recent highs of 47,250, but also, getting past that. So in that sense, maintaining a long bias and using this decline to buy into it, keep a stop below 16,200. Sorry, 46,200. And on the stock side, I have a buy on MRF with a stop at 1,15,000 for targets of around 1,22,000. And the other one which I like is Glenmark Pharma. That's a buy with a stop at 808 for targets of 840.
Okay, thanks a lot for that. Well, power is one space that is coming back in a big way, so don't lose sight of that. Tata Power is now up almost 5%. NHPC is up almost about 3% This whole power and renewable energy space has come back in a big way over the last many days. So the market has taken note of that. But let's shift focus to the commodity space. One big positive trigger for this market is the fall that we've seen in Brent crude prices. And Manisha Gupta has been, appraising us of that. Manisha, morning. What are you tracking today?
Sonia, thank you for that. Well, this week, every day, we have seen a decline come in for the crude oil prices. So we are trading below 75 for the Brent prices. We're also trading below 70 for the WTI prices there. And it's a 5-month lows that you are looking at in sense of crude oil prices. So with nearly 4% of a decline coming in for the crude prices, this hasn't been such a great week. And not just crude. This is what the other commodities also have done. So while the crude is trading at a 5-month lows, you have natural gas at a 13-week lows, heating oil 4-month lows, and the gasoline prices are the most hit, trading at a 1-year lows in the international markets. This is what we've done in sense of the previous week in a case of prices there. So while the week has seen 8% of decline come in for the crude oil prices, natural gas is down by 8.5%. It's a 6% decline coming in for heating oil and gasoline. The only thing, as I've been telling you, the positive trade has been in case of coal, where we've seen 9% of gains. Nearly $140 a ton is how coal prices are trading right now. But for the crude oil prices, there are various concerns right now. To begin with, while we've seen the U.S. inventories for crude decline, crude gain up, the gasoline inventories have jumped up by 5.4 million barrels. So that tells you that the demand seems to be slowing down in U.S. as well. And not just U.S., you are looking at concerns that the OPEC and allies, while they have talked about a 2.2 million barrels per day of a cut, but remember that is voluntary, and markets do believe that you may not see that happen on ground. On paper itself is much on the lower side there. And then apart from that, it also is about the Chinese demand, which has been on the weaker side. From Moody's giving an outlook in sense of negative, the kind of imports that we saw in China in major part of this year tells you that China is sitting on huge inventories, and if the demand does not pick up, then China may not want to import so much going forward. So that's one another market which may not be looking at so much demand coming in. The dollar index trading at a 2-week highs has been putting pressure as well. And then you have the PMI data that came in from Japan, US, Eurozone. All of that came in on the weaker side for the month of November, and that has been weighing onto the markets. It also has been about Saudi Arabia for the first time in 7 months cutting the prices, official prices that is, for the month of January, saying that the demand seems to be easing and the premium is coming off. And that tells you that those 95, 96 kind of levels that we saw in the month of September perhaps are not coming in a jiffy. The street is expecting that there could be a surplus in this quarter and the next as well, and the demand hasn't picked up yet. It's all going to be about the US non-farm payroll data tomorrow. All eyes on that for further direction.
All right, Manisha, thanks a lot for that. Let's sip into a quick break. On the other side, we'll get you an exclusive conversation with R. Shankar Raman, the whole-time Director and Chief Financial Officer at Larsen & Toubro. Stay with us.
Congratulations on your anniversary. I've been talking to the channel for 20 years, so it's my pleasure to be
Welcome back. To reiterate, we are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us. So joining me now is the Group CFO and Board Member at Larsen & Toubro, Mr. R. Shankararaman. Mr. Shankararaman, thank you very much indeed for joining us on our big day. We would like to think that we are lucky because the global and the Indian news is also brimming with positivity. Let me start with the GDP number, which surprised hugely on the positive. It's not just the 7.6% GDP number. It was largely because manufacturing was 13.9% and construction, something that you would be interested in, has grown at 13.3%. So let me start there. You gave us a very good guidance in terms of your revenue growth. Do you think it is going to be even better than that, given this macro performance?
Thank you, Lata, for having me. And let me start by wishing CNBC-TV18 and all of you my heartiest congratulations. Entering into the 25th year is a big milestone, and I think sustainability, staying relevant, etc. has contributed. So credit to all of you who are part of that brand to have made the brand so enduring and dear to the viewers. So congratulations.
Thank you.
Now coming back to the question that you asked, I think it is no surprise that the construction contribution is picking up, because if you look at the orders that have got placed out over the last 2 years, ever since the government adopted the policy to be investment-led in terms of creating employment, making sure consumption demand revives on the back of that employment generation, it was but natural that with the lag of 1-2 years, construction will begin to pick up. Most of the projects that were awarded post-COVID are all in advanced stages of construction, and consequently, it is not surprising that their growth contribution is significant. We fortunately are in the thick of many of these important projects, and one of the reasons why during the discussions that we had post our half-yearly results was that we stuck our neck out and said that we are very likely to outperform our revenue projections that were put out as guidance at the beginning of the year. We had guided somewhere between 12 and 15%. Yes. And looking at the pace at which things were moving, we were reasonably confident that we could possibly exceed that guidance. By what order of magnitude could depend on so many other factors, because today, as we construct more and more, still clearances and approvals are part and parcel of that construction journey. Not everything is available to companies upfront for us to predict as to what kind of resources it has to deploy and how the revenues will map out. Now, for example, the poll in 4 states or 5 states actually put a temporary halt on some of the work that we were doing in those states. Now, we are also heading towards the national elections. So consequently, some interruptions are to be anticipated, which is what is making the whole job of predicting the exact percentage of growth over and above our guidance becomes tricky. Okay. We do believe that the year could go past, because our assessment is the elections could be mostly in maybe April. Yeah. Around the time when schools shut and that infrastructure is available as polling booths, etc., could be the ideal time, but one never knows. So consequently, depends on whether we have the entire 12 months or we have a portion of that chopped off, would determine the growth. But the momentum is robust. Okay. And I'm glad to tell you that the authorities, be it local authorities or central authorities, and the multilateral funding agencies are taking enormous interest to ensure that the cost of infrastructure that we are building stays competitive by arresting the time overrun. I think it's good that the system has recognized the cost overrun as a consequence of time overrun. So if you want to get the cost under control, we'll have to get the time under control. And that is also helping the industry's costs.
Yes, we saw your working capital to sales also move into a very healthy direction. Should you see more of that, since you say that everyone is now conscious of time overruns, more improvements in working capital to sales?
There is a natural cycle to the invoicing and collections. And given the fact that many of the projects are state or central government sponsored projects, there is a lead lag in collecting this money. My sense is that if we are able to operate working capital at about a 16 to 18% band of the revenues, I think we are doing a commendable job. There is always a possibility to keep improving because never say never for any such improvements. But it does look more practical to assume and operate at a 16-17% band rather than look at a 7-8% band.
Okay, fair enough. Let me come to the order book. I mean, you were always expected to better than that 10 to 12%. I mean, by a huge margin. But now you've lately announced a lot of big orders from the Middle, even more big orders from the Middle East. So you don't want to increase that order book guidance? Or even if you can tell me this, do you feel that you will, outperform by an even larger margin than you thought perhaps a couple of months back?
No, when we last spoke end October,
yes,
we did mention that we will outperform the guidance. If you really see, the first 2 months have been relatively quiet of the current quarter as compared to the past 2 months leading up to the end of the previous quarter. There is a certain volatility and fluctuations to this ordering momentum because of the processes involved. It is good that the order inflow is helped by some large orders from Middle East. But if you look at the pipeline of orders that are lined up, I think there is still some more distance to go before we can announce, complete outperformance to the order of magnitude that you possibly are hinting. We will have an opportunity every 90 days to revisit this. So end of this month, as we gather ourselves to see how the last quarter of the year looks, we will have an opportunity to see whether we can be a little more precise than what we are. But I do expect a certain slowdown in the last quarter. Run up to elections have always been indicative of that, because any orders that you give out now, invariably the execution will be carried under the supervision of the next government.
Yes.
Now, how far will the government's, the current incumbent government will sort of commit themselves to these programs is to be seen, because we've had history of some of the state governments cancelling projects that have been announced by the earlier governments for no rhyme or reason. And I think it has put a lot of construction industry into a big spin because of the resources that it had committed, etc. So even in the industry, we will possibly be a little cagey and slow of the orders that we win in Q4 before we really go full clip. So I think there is a certain natural headwind that will develop. So I think we'll have to factor for that as well.
I wanted, if you can update us on, the vertical of electrolyzers and green hydrogen. That was the other thing Mr. Subramanian was very excited about. So any update on that and its future in the next 2 years?
Yeah, I think we realize the fact that energy transition is going to be a big play globally, and India cannot be left behind. And consequently, when we looked at the various opportunities for this transition, two things stood out. One is India needs to get more solar generation while waiting for solution for battery storage, etc. The solar generation needs to be augmented. So we started betting on solar projects. Fortunately for us, international orders also came our way. And since today we are fairly large with almost $6 billion worth of order backlog just in solar EPC projects. Secondly, we also looked at hydrogen as an emerging fuel source for industrial application at least, because we yet do not know the cost competitiveness and the safety factors around its use for individual consumption. But at industrial application, automotive transportation purposes, it did look promising. So we said that we will get into that play by manufacturing electrolyzer, which is a key component for hydrogen generation. Fortunately for us, I think we scouted around and got a technology tie-up with McPhy Energy of France. Today, as we speak, the first electrolyzer is under construction. We are putting that together in our Asira plant. By end of this fiscal, we'll possibly have a prototype, and we could check that for its application, its features, its cost competitiveness, global attractiveness, etc. And if the product marks all this well, we'll possibly experiment it with a couple of hydrogen EPC projects, by which time we hope to get. And then if that does well, we will possibly take it as a global product. So there is an opportunity to scale this electrolyzer manufacturing activity. And we think, being the manufacturing experts that we are in some of these areas, we think we stand a good chance.
Okay.
The other area that actually excited us is putting together as a EPC package for hydrogen manufacturing. Fortunately for us, we struck a transaction with IOCL at an MOU basis. IOCL as well as Renew Power will provide the green power for the electrolyzer manufacturing. We will put up a plant which will generate hydrogen, which will be used for the refinery of IOCL. Depending on how this goes, this can be replicated in the other refineries of IOCL, as well as replicated in other refineries beyond IOCL.
Okay.
So this being, and this is more public sector led at the moment, but I'm sure the private sector, who consume a lot of industrial fuel, would also look at this, provided the solution is cost effective and functionalities meet their requirements. So we are pretty excited about application of this hydrogen through our EPC and electrolyzer manufacturing. Added to this excitement is our recent foray into semiconductors, because that's another area that we have been trying to explore as to what is it that we could do. We realized that our ability to compete with global giants on manufacturing fabs is going to be very limited. So consequently, we shifted our attention to design. And now we have put together a company, and we're in the process of assembling a team which will work on design, 40 nanometers and beyond in terms of the chips. And we will possibly co-create a design along with manufacturers, OEM. And hopefully, if the functionality tests are passed, we would design those chips using the talent pool that India is blessed with on chip designing.
Okay, now that's all the cutting edge areas that one would want the company to be in. Very good to hear. It's not surprising, therefore, that the L&T stock is at all-time highs. You're celebrating along with us. Thank you very much, Mr. Shankar Raman, for this conversation.
Thank you. Hopes precede actual performance. We hope we back it up with performance. Thank you.
Thank you, sir.
All
Thank you
the
very
best.
much. Thank you very much for that. Have to take a quick break, and thereafter it'll be time for Chartbusters.
I wish all the best for the CNBC-18 birthday on 7th December. It will be a very, I wish that it will be a very successful, grand success.
embarking on a quarter century of excellence.
Hello and welcome to this special program on what is a very special day for us here at CNBC TV18. We are 25 years old today. And to mark this milestone, we have with us Ramdev Agarwal, Chairman of Motilal Oswal Financial Services. He's our guest editor. Ramdev, of course, is someone who needs absolutely no introduction at all.
All right, exciting show lined up for you. Ramdev is someone who is regularly referred to as the Warren Buffett of India. Ramdev, it's a pleasure to have you with us here on the show. We will, of course, talk markets, politics, money-making ideas with him. Ramdev's big bet, by the way, is Zomato. He has been a big votary and champion of the theme of value migration, and he thinks that the runway for growth for Zomato is a long one. So what we've done is, very interestingly, invited the Zomato management also on the show in the next half hour. Very exciting conversation lined up. We have the Zomato management waiting by with us. So let's go straight to, discussions. Ramdev, first on the market, we can't start the show without asking you your view. And we're, of course, celebrating 25 years of business news excellence. Yes. So thank you for being a part of our journey. I think you have been with us throughout these 25 years, right?
So that's what I was, my congratulations to CNBC and its entire team. And I'm really fortunate to have been coming here for the last 25 years on various occasions. So I've seen the entire journey from somewhere in Worli to Empire, then here. Yeah. So it's been amazing thing. And the consistency of CNBC brand. And CNBC has changed the way people look at the market. Yeah. The way accessing the market. So all the screens you see of the business channel, they look CNBC.
The consistency of the CNBC brand married with the consistency of the Motilal Oswal brand, right? It is brand building together, and that's how this equity market cult has also sort of developed. Yes. We've seen it grow in front of our eyes.
Huge contribution of CNBC in spreading the equity culture, knowledge of the equities. Yeah. I mean, a lot of, I get to hear a lot of people that all the YouTube actually hosts your programs. So they learn, they play repeatedly, and you create those programs and people learn out of that. So beginners, they get, so a lot of people are benefited in very different way apart from watching it on a day-to-day basis.
And thank you so much, Ramdev, for being a part of it for the last 2.5 decades. So we rely on you, I can say that much. We spoke around the time of Diwali.
Yeah.
And at that point you had said, one way or the other, post the state election results, market is running up.
Yes.
It's going to run away.
Yes.
What a run we've had, right, in the last 3-4 days. And your call was that we will get a rally all the way into general elections.
Yes.
I mean, you reflect on what you said and what we've seen.
Yeah, so we have started with a, huge 6s and 4s with the state election. And I mean, at times it is scary to see at what pace market has moved from 20 to 21,000. It's been just few days, So I don't think we can maintain this pace. We need calibration, otherwise wrong things start happening, wrong kind of trades start happening, wrong kind of money starts coming in. So I think we need a little breather. But I don't know what will happen in the short run in the market. But, the real good thing about, actually India is Sone ki Chidiya, maybe in the past in the economy, but I think Indian stock market is Sone ki Chidiya. If you see, we are at about $4 trillion plus counting. And it has been very consistent. If you see last 20-25 years journey at about 12 to 14% kind of a compounded return, where can you get it? In a very predictable way. And I mean what I'm saying. Yeah. It doesn't break down. Of course, in 7-8 years when you do 6-7x expansion, then of course it corrects one wholesale. But otherwise, it has been amazing journey. And I think post-COVID, the new journey started from 8,000-9,000 index. And we are building up. At times it feels that are we in new era or something like that? Can we get 15-17%, 20% compounded? I would think that has little caution. And from this level, build between 12 to 14, build 12% compounded rather than 14% compounded in your expectation. But a lot of wonderful things can happen. Oil can fall to $50. Rupee can strengthen. We can have a compounded growth of 7-8% for many years to come. So it is India's decade, maybe India's few decades. And in that, corporate profits can also grow at 15-17%. Digital era is there. So we have companies which can grow very rapidly. So the complexion of top companies can change the way it has changed in US. I think there is a chance that here also we may find 30-40% growth for these kind of companies, a new normal altogether.
Just one briefly, Ramdevji, the election verdict itself, just to go back to that. What does it mean from a market point of view, political economy wise? Which sectors will, because we've seen a lot of reform and now the conviction that more will happen will get strengthened.
Yeah, so it's more of the same. But what happens is that if you keep growing at 6.5-7%, I'm not talking about anything higher. If you keep growing at 6.5-7%, your nominal GDP grows at about 12%, but the tax collections they go at 13-14%. Now, when tax collections grow like that, there is a lot in the hands of government to spend. There is so much of infrastructure deficit. We can spend $10 trillion and still we are not done. So there is a huge backlog of infrastructure and your defense and railways, and so I think the real thing is that how well economy does and how is the government collection. So government tax collections are the core of and I mean when you are a $1 trillion economy, you can collect only say 12% or say 15% tax. You can collect $150 billion. When you have $4 trillion, you can collect $600 billion. When you are $8 trillion in next 5, 6 years, 7 years time, you'll be able to collect say more like $1.5 trillion kind of taxes. So the size of the projects, the variety of the projects you'll get to see, the size, they will just explode. So I think like if you hear Mr. Gadkari, he says that I don't have any shortage of money. I'm doing 1 lakh crore project between Mumbai and Delhi. So those kind of 1 lakh crore today is looking very big. But a day will come when he will talk about 5 lakh crores a single project.
Okay.
So that's the kind of expansion we are going to see. I hope there is no break, but nothing happens in a straight line.
So, you know, from a stock market perspective, right, Ramdev, PSUs have done really well.
Yes.
But there are so many spaces under that. There are PSU defense companies, PSU power companies, banks. From here on, where do you see both value and growth in the PSU basket?
Yeah, so see, PSU basket were beaten down big time. I mean, they didn't, I mean, they wanted little lower valuation, but not so much lower. Like if the index is trading at 22 P multiple, they got stuck in single digit, like 6, 7, 8 P multiple. And some of them are large monopolies, very important part of the economy, like all the oil companies, your power grid, your some finance companies. Also, they were all at, in fact, low single digit P multiples. So obviously, I mean, it's like saying that in South Bombay, property prices have gone from say 50,000 rupees per square foot to 1 lakh rupees per square foot. But in Andheri and Bandra, it is still at 20,000. It can't remain. So there is an arbitrage, and I think under this government in last 7-8 years, I believe at least the banking side is being managed much better than the way it was managed earlier. There is no directed lending. There is not much of interference in their work. So I mean, all those things are playing out, and finally, when the market is taking off and other markets are at 25, 30 P multiples become normal, these companies must go up. And they are very important. And they were an important part of the infra build-up. And the moment infra build-up started, your defense build-up started, I mean, the story
But some of these companies have rallied a lot, right? Like the defense space, for example.
Yes.
Do you think there's still more growth there?
Frankly speaking, I have not been beneficiary of this.
Okay.
So the guys who have, studied more about it, ask them. But I think this is a good time for all the companies which are running well. This is an amazing time for Indian equities.
Ramdevji's big bet has been financials, banks, capital market plays he's been extremely bullish on.
Yes.
Those remain the focal kind of points where a lot of wealth can be made in the next couple of years?
Yes, because the shift of Indian retail, which was, particularly it was a bank-related kind of savings. The first fall point was the banking or maybe to some extent insurance. But now, thanks to COVID, digital onboarding and digital infrastructure, and this option trading being popular, you see what kind of a participation you are getting. We are getting about 3 million customers per month, 100,000 customers per day. I mean, we are talking about 100. I think I just saw November data. It is 133 million as of last month. So we are headed to become 250, 275 million. So my sense is that demand for equities will continue for next 4-5 years without any problem.
All right.
Without any problem. So in fact, particularly if the continuity of the government is there, then it gets strengthened even more so. So I would think that in that backdrop, you have to see which are the companies who are able to scale up, and maybe at index level it is expensive, but at individual company level, the news stories, the turnarounds, the companies which are
digital focus,
new companies which is getting listed. In fact, this is a amazing time, once in a lifetime kind of opportunity for unlisted companies to come in the market. The large unlisted companies must come, create wealth for themselves and create wealth for the nation. Let the people per se participate. And I'm sure the guys who get listed, they will have, because I'm listed, I know the benefits of listing is more than remaining unlisted.
Okay. Well, one space that you've been really bullish on and one stock is Zomato. So what we've done is we've invited the management of Zomato to chat with us. Very interesting discussion lined up. So let's slip into a very short commercial break. Don't go anywhere. When we return, Akshant Goel, who's the Chief Financial Officer of Zomato, will be with us.
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Well, Ramdev Agarwal is our guest editor. But the company that we are focusing on now is Zomato. The stock has had a roller coaster ride since its listing in July of 2021, hitting highs of 169 rupees post-listing, but also seeing lows of about 40 rupees in a year. But since then, a lot of water under the bridge. Markets are excited about prospects for Zomato. Stock is reflecting that. Mangalam is standing by to talk to us about that journey of what we've seen so far. Mangalam, over to you.
Well, as far as the new age companies are concerned, in that Zomato has actually scripted a compelling saga from a blockbuster listing highs to weathering storms of new age challenges and ultimately emerging fundamentally stronger than ever before. So let's delve into the riveting journey of Zomato itself, the rise, the fall and the resurgence as it were. First was the blockbuster listing that happened in 2021, offered at 76 rupees, the stock listed at 120 and soon after hit an all-time high of 169, captivating the market with its promise and potential. Then came 2022 and along with it, the challenges of all these new age companies. I mean, starting with the US interest rate hikes, the post-COVID lull in demand, there was low visibility of profits, senior level management exits, institutional investors and PE supply, as well as high valuation. So we saw a big decline in all new age companies' share prices, and Zomato wasn't any different. The stock hit a low of 40.5 in July 2022. But this was just the beginning of an incredible turnaround, which we now call the resurgence. Zomato's Phoenix-like rise was fueled by strategic moves. One was improvement in their operational metrics, focus on core growth engines of food delivery, and paring all non-core businesses out. Their enhanced market share further aided improvement in their overall business. And that's not all. Robust growth and unit economics of their Blinkit business, which is Zomato's strategic venture, added further fuel to the growth engine as well. So here's the journey of the business in numbers. First up, we have the food delivery revenue that was absolutely consistent. And in that consistency, we had a strong turnaround in their food delivery EBITDA as well. From a loss of 113 crores, it gone all the way up to 204 crores. Secondly, from a solid growth standpoint, the average order value of Blinkit, which is now a value driver for the company, has crossed that 600 rupee mark. And in the previous quarter itself, it's turned contribution positive, contribution margin positive. And as a result of it, it's just a matter of time before this turns operationally positive as well. So let's talk about the key triggers that they have: increasing transactions and transacting customers, them also increasing their order frequency, higher loyalty and stickiness coming in from Zomato Gold members. They have, more share than Swiggy now. Swiggy's peak has been 52%. Now the market share is around 46%. They've been improving their operating metrics of the Blinkit business as well. And at the same time, they have a huge cash balance of close to 11,761 crore rupees on their books as well. Is the street excited by it? Are the brokerages giving a vote of confidence to Zomato? Yes, we have, nearly 86% of the brokers on the street have a buy or a positive rating on Zomato, with the target prices ranging anywhere between 130 to 170. So that's the story so far of Zomato, the rise, the fall, and then the resurgence.
All right, thank you. That's very well put there, Mangalam. So the rise, fall and the resurgence of Zomato. In fact, now we have the management of Zomato joining us, and of course Ramdev Agarwal of Motilal Oswal Financial Services is sitting by with us. Akshant Goel, who's the Chief Financial Officer of Zomato, is with us right now. And Ramdevji, you want to take it forward with Akshant?
Yeah. Hi, good morning, Akshant. Can you hear me?
Good morning, Mr. Ramdev. Yes, I can hear you, and thank you for having me on the show. And congratulations to CNBC on this 25-year milestone.
Yeah. So they are on run for 25th year. I think Zomato is, just about 2-3 years on the stock market. So, one of the bullishness I have from my side is that in looking at the global scenario, particularly US big 5, 7, 10, they're all digital companies, except probably Berkshire Hathaway. So, what do you think? I mean, this kind of, apart from Zomato, you are working very closely with digital companies. You have seen them working. So, is it likely that in next 10-15 years, we are going to see many more digital companies in the top 10, 15, 20 kind of ranking in India?
So if you look at the top 5-10 global companies, which you mentioned are the largest companies in US, likes of Google, Facebook, etc. They're, by the way, also, I think, fairly large in India. And their India business is likely to remain unlisted. So it's possible that, a large part of Indian digital tech market cap is never listed because of them being owned by these large players. Having said that, I do believe that we'll see a lot more new age companies coming from digitally tech-enabled sectors listing in the next few years. I think we saw one round of that happening in 2021 when 5-6 companies listed. And as the business models have become much stronger and economics have become better in the last few years, I do think there'll be a few more listings down the line, which will create more availability of tech digital businesses in the country which are listed.
You know, one other thing about Zomato is that not only in food delivery, you guys are duopoly kind of situation, but you have Blinkit also, which is on top of it growing very rapidly. So, but then still combined as a company, you are not made profit. So, is it a story of, it is a story full of hope that someday you will make money, because ultimately stock market is about the next discounted value of future cash flows. So, what is your view on, for how long one has to wait to see, within your own disclosed kind of numbers, can you guide us in terms of saying how exactly profit and profitability and profit numbers will start flowing in next 5-10 years also?
Yeah, so last, I think June quarter this year was the first quarter when at a company level we were profitable. We reported a small 2 crore profit after tax. And then September quarter that increased to about 40 odd crores, right? So company, I think as a group combined business is already profitable, and I think it's only going to increase from here as the businesses mature. And you're right, I think Blinkit is a relatively still nascent business. We need investment in that business for it to continue to grow. The top line of that business is doubling year on year, right? So I think it will be in that phase where it will take a while for that business to generate meaningful profits. But I think food delivery is shaping up well, and as a result, the sum of those two should remain profitable, and therefore the company at a overall level should continue to remain profitable and grow from here.
But do you think Blinkit itself can be a lakh crore or 2 lakh crore kind of turnover company in next, in midterm kind of thing, the pace at which you are going?
Yes, it's already north of 10,000 crores in terms of GOV top line annually.
Yeah.
And
yeah.
Really speaking, it is a 1.5-year-old business right now, right? So, and still growing at 80 to 100% year on year, right? So, I think, it's a long runway, of course, from 10,000 to what you're saying, 1 lakh crore, but it's, I think, fairly probable that the business will continue to scale. And at some point, we think it's likely to become larger than food delivery. Right? Food delivery today, if you look at the top line, from a GOV standpoint, it's about 30,000 crores. And if Blinkit business continues to double year on year, and food delivery is also growing 25-30% year on year, but at some point, the trajectory of the two businesses in terms of size will cross, I think, in the next 3, 4, 5 years. And from there on, I think those businesses have a long runway to go.
One of the comment against your food delivery business is that it's a fundamentally very low margin business, 4-5%. Food business can have 20-30% take rate and things like that. But in grocery, it's highly competitive, and the likes of Avenue and all, they make just about 4-5% net margin. Now you deliver at home free of cost or maybe some charges. So how do you think of making money out of them?
So our ambition also in this business, our stated objective goal has been that this business should get to 4 to 5% margin, and that's the goal. Right now, we are not there yet, but as the business scales, the gross margins will increase. We're also charging consumers here delivery fee, so that's a big driver of profit as well. And there is then this ad sales, the advertisement spends that brands do on the platform, which also adds to the bottom line. So I think there's some differences in the business models of a modern retail business versus a quick commerce business. But our view is that the margin profile should be very similar in the steady state.
Yeah, Sonia?
I just had one follow-up on Blinkit actually, since we're having this discussion, and I think everyone is really interested in the quick commerce space and the opportunity that it brings up, right? You spoke about the potential for profitability, but I think earlier you had guided for a break-even, EBITDA break-even on Blinkit by Q1 of FY25. Are we on track to meet that timeline?
Yeah, so far we are on track, Sonia, on that. So that should happen if everything is predictable and remains, the market doesn't change.
So the reason I ask is because, I mean, you are a market leader in this space by a large amount. I think you're 1.2 times bigger than Instamart at the moment. But I just want to understand in terms of market leadership in the quick commerce space, what are we looking at? What is the kind of opportunity that you see for Blinkit over the next couple of years?
Yeah, so I think it's a fairly large market. I think we're not competing with any one player or a particular format. For consumers, they have multiple choices on how they transact or do commerce in the country. There are the local kiranas, there are modern retail, big box retail format stores. There are large e-commerce platforms, and then you also have quick commerce platforms, right? So from a consumer standpoint, I think all of this are, in a way, ways to transact and buy stuff in India. And that overall market is so large, I think that all of these individual formats can survive and become fairly large and profitable, right? So I think the focus right now, therefore, is more on like how can we solve problems or create more use cases for consumers to transact on our platform. And if we're able to do that well, I think the market is large enough for everyone to grow, right? So, and that's the opportunity which Mr. Ramdev spoke about. I think, it's the offline retail market is in a $1 trillion or more in size, right? And even if we get like 1% share of that, we'll build a $10 billion business. And today we are 1/10 of that. So I think, yeah, that's how we look at it.
Yeah, Akshat, one of the things was that I think you guys started delivering gold coins also. So what are the things which are still not delivered? I mean, you're delivering food, you're delivering grocery. What are the other things Amazon is delivering which you guys are yet not delivering? Because you can deliver everything in less than an hour. They are delivering after a day or two.
Yeah, so I think so. The idea is, I mean, for us, the fact that inventory should move fast is important because the deliveries are all happening from a small store, which is located in a fairly expensive real estate in the middle of the demand pockets in the country. So, so I think we are in that phase where we are experimenting with multiple categories and figuring out, what is it that consumers want and whether it makes sense from an economic standpoint to deliver those things or not. So in that exploratory journey, we've tried many things, as you mentioned. So today, electronics is a large portion of what we sell, beauty, personal care, children's toys, stationery. I think these are all emerging categories where we are seeing a lot of demand from customers and we are seeing economics are also good. So I think we'll continue on that journey and, whatever makes sense from both demand and economic standpoint, I think we'll keep adding that to the store. And eventually the idea is that we should be able to utilize the real estate behind the business, which is the dark store, as much as we can and increase the throughput. And that's when the business becomes most valuable for all stakeholders.
All right, we'll leave it there.
I just want to mention that I, for one, I'm addicted to quick commerce, but I'm brand agnostic. Okay, so whether not a day goes by that I don't order on either Instamart or Zepto or Blinkit. So I must say you're in the right space at the right time. But you want to end the discussion with him?
No, it's wonderful. I think we have a company which is likely to rival the unlisted ones like Amazon, Flipkart. They are the big daddies of e-commerce earlier. Now these are the ones who are. They have done the difficult part, delivering in 10 minutes and half an hour. So delivering in 1 day, 2 days, 5 days. I think it is going to be a huge customer experience the way we live. I mean, other day somebody came for breakfast. We changed the way it looks. My table looks very different in half an hour.
Because everything comes so quickly now, right?
Yeah.
Okay, well, Akshat, congratulations once again. And thanks a lot for joining in and speaking to CNBC-TV18.
Thank you, everyone.
Okay, well, Ramdevji, thank you very much for being with us here on CNBC-TV18. Once again, a pleasure to have you with us here, sir. Thank you. Well, it's a wrap on this special show. Thank you very much for staying with us. More coming up in just a bit.
CNBC-TV18, embarking on a quarter-century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Hello and welcome to CNBC TV18. I am Reema Tendulkar and with me is Pavitra Parekh, and it's a proud moment for the entire CNBC TV18 family as we enter our 25th year. And I want to, on behalf of the entire team, thank all our viewers for their continued support and loyalty through these years.
Oh, absolutely. You know, it's been a privilege and honor to be able to bring the news every single day. And we have an audience which has stuck by us all through the years. Our entire team, there are so many people that have been here for this entire period, right? So many people behind the scenes as well. So truly celebrating CNBC and the fact that we're a quarter of a century old now, and we have a power pack day planned as well. We've been bringing the best market voices, the best corporate voices as well, and that action is going to continue.
Okay, and let's begin trading hour then by focusing on the big RBI decision tomorrow. That's the 8th of December. A CNBC TV18 poll expects RBI to keep the repo rate unchanged in its upcoming MPC review. Ritu joins in with the findings of the CNBC TV18 poll. Ritu.
This time around, it is not the rates or the stance that the markets are going to be watching out for, because that's a near given in the current scenario. Rather, markets are on tenterhooks to see if the governor is going to make any other explosive announcements like raising risk weights or open market bond sales. Now, all of the respondents to CNBC TV18's poll expect no change in the repo rate this time around. That is a status quo policy for the 5th consecutive time because of the stronger than expected growth numbers and the continuing inflation uncertainty. In fact, the respondents to our poll have ruled out any further rate hikes in this fiscal year. And as for the first rate cut, while 20% are expecting it by the first quarter of next fiscal, a larger majority of almost 70% expects it only in the second half of FY25. No change is expected in the stance, which is going to be retained at withdrawal of accommodation. Not even an indication of a possible change in stance just yet, because many believe it will be tough to find a consensus among MPC members to shift to neutral just yet. Now, the inflation forecast for FY24 at 5.4% is widely expected to be left unchanged, with just 10% expecting a slight revision upwards. On the GDP numbers, a large majority is expecting RBI to up the 6.5% forecast for the year to between 6.6 to 6.9% on the back of a stronger than expected show in the second quarter. Now, the governor himself is expected to sound more hawkish than dovish in his statement, because we're not really out of the woods just yet when it comes to inflation, and risks do remain. Now, on liquidity related measures, some are expecting clarity on the OMO bond sales, which was announced. They will also watch out for any changes in the standing deposit facility mechanism to tighten policy without actually tweaking rates, and some others are looking for more short-term liquidity-related announcements that the governor could make. Now, as for other prudential measures, the general expectation is RBI could tweak prudential norms where it senses excesses like it did for unsecured loans. Perhaps there will be more standardization of risk weights. The governor also earlier warned about usurious lending rates from certain microfinance lenders, and so the markets will watch for any regulatory action on that front. But all of these may not necessarily happen in this policy itself.
Thank you, Ritu, for that important preview to the RBI monetary policy. By the way, markets are recovering. The low on the Nifty in the first 1 hour of trade was 20,850, and we managed to recover about 72 points from that low. Look at that intraday recovery that we've seen in the morning trade. The Nifty is on the verge of breaking into the green, ditto for the Sensex, and the Nifty Bank has actually managed to recover 350 points from the day's low. But as a part of our birthday celebrations, let me go to our main lady, Shireen, who is at the Delhi studio. Shireen.
Well, hi guys. What a morning and what a moment it is for all of us here as we enter our 25th year. I was just going back in time to when we started and where we are today. As I said, it's really been an effort of learning, of disrupting ourselves, of creating this category of the business news genre in India. And what fun we've had. What a remarkable journey it's been. What fun we've had along the way, of trying to improve ourselves every day, stay relevant to our audience, ensure that we bring you the news that you you can actually use. So it's been a remarkable journey, and it's 24 years for me as well. So huge nostalgia trip. But really, I want to express my deepest gratitude to each one of our team members here at CNBC TV 18. I don't believe we could have asked for a better team, the most passionate, committed individuals with a lot of patience, a lot of perseverance, and they make the magic happen morning after morning, afternoon after afternoon, and evening after evening. But also an equal amount of gratitude and thank you to our viewers who have stayed with us through the course of this journey, tuning in day after day, watching us, sending us your feedback. We love to hear from you, and we promise that we are never going to take your time for granted. We're not going to get complacent about our leadership. It is a phenomenal feat, though, I have to say, to have continued to stay leaders over the last 25 years through the many ups and downs that the world has seen, through the highs and lows of the markets. But we have, of course, continued to endeavor, continued to stay true to our DNA, which is to bring you actionable, verifiable information that you can use. So a big thank you to all our viewers, a big thank you to our guests. They join us every day, so they're really also a part of the CNBC TV 18 family. They help us stay ahead of the markets, and they help our viewers also stay ahead of the market. So it's been an absolutely remarkable journey for us over the last 25 years, guys.
All right, Shireen, and thank you to you. You've, been the most wonderful leader, and you provide the inspiration and motivation that we need every single day. So thank you for doing that day after day, and here's to the next 25 years as well. We're going to continue the party here on CNBC TV 18, but we do need to slip into a short break for now. When we come back, we're going to get you a very interesting conversation on the markets. Prashant Khemka of White Oak Capital Management will be with us for that conversation. Stay tuned.
CNBC TV 18, embarking on a quarter century of excellence.
Hey guys, welcome back. You're still tuned into Trading Hour here on CNBC TV18, and we have a very special conversation lined up now. We have Prashant Khemka, founder of White Oak Capital Management, joining us to discuss the moves that we've seen in the market and where things could really be headed from here on, as well as maybe how you would play this theme. Mr. Khemka, thanks a lot for joining us today on this day, which is, so big for us. We are celebrating 25 years. So first off, thank you for joining us, not just today, but, being a part of this journey, which has spanned so many days. And that said, I do want to ask you about, where you see the Indian markets headed from here. Everyone's been talking about the fact that this is India's time, this is India's decade. But where do you find the opportunities today?
Certainly. Thanks for having me here on the show on this very special day. And I was just listening to Shireen a few minutes ago talk about the 25-year journey. So let me take a minute and add a few words to that. As Shri was talking, I was reflecting back the first time I saw CNBC in India. So I used to live in the US in the late 90s and the early 2000s. So one of those trips when I would come here every December, winter holidays and sometimes summer holidays. So when I first saw CNBC on the TV, I was so excited because in US, you obviously have had this genre for many years. And very true, you created this genre and it has played a very important role in attracting, say, millions of investors, retail investors. That's been the best part. They've gotten attracted to the market after watching, you all on the TV, and they've had their own fantastic journeys over the last decade, 2 decades, 25 years, and so on. Whenever they started, watching. So kudos to you all, and thanks for having us also participate in that journey through these interactions. And wish you the very best, and wish you that you break all the viewership records in the coming years as the markets continue to break the records. All right. So coming to then as a segue to your question, yes, the outlook for the market is very solid at this time, very optimistic. The markets have risen over the last couple of years, and global investors do point out that Indian markets have done much better than other emerging markets or even developed markets. But when you look at in context of the earnings growth that Indian markets have delivered over the last 3 years, so the pandemic year, the fiscal year 21, was supposed to be initially a horrible year for earnings, but ended up being very positive year in itself and acted as a catalyst. Since then, the earnings trajectory has moved up to 20% CAGR over the last 3 years. Prior 12 years, we had about 5% earnings growth. Last 3 years, about 20% earnings growth, and projections are for mid-teens earnings growth going forward, which is amongst the very highest globally. So while the markets have trended higher, the P multiple actually has not gone higher. In fact, it is somewhat lower than what it has been on average over the last 10 years. Though relative to other markets, it might have become more of a premium because other markets like China, led by China, I would say, has done, China has done very poorly, and other markets led by it have done poorly as well. But those are for separate reasons. For India, I do see very strong interest in amongst investors globally, and the political uncertainty, which is right now of primary concern, or I would say is the primary factor that's been holding them back. I think with the events of the last weekend, many are overcoming that as well and not waiting till May.
Prashant, thank you very much for being a part of our journey, providing that wisdom every time you come on the channel and help build this entire cult of equity market investing. Do you remember the first time when you came on the channel? What was your experience like?
That's a very good question. I would get it wrong. I think the first material meaning significant time period, would be the Asian Tiger Show with Udyan Mukherjee.
Okay.
But this was, because this is only in 2017, whereas I've probably been appearing since much earlier. Sorry, my memory is bad, so would take that back.
All right. Okay, so let's get back to the markets, you said that the outlook for the market is very solid, but then there are those pessimists, the naysayers in the camp who believe that the markets have priced in all the good things. The political certainty, the fact that we're going to get a very strong mandate once the election results come out in the middle of 2024, the earnings growth, the macro stability. So what can positively surprise to provide that return, extra return? In fact, the only surprise can be negative because you're anyway expecting all good things. How would you respond to that?
I would say, look, that's why I use the word solid. I've never been one to necessarily pound the table that over the next 1 year, market's going to give some heroic returns. I think low double-digit returns are reasonable expectations. That's what the market has provided over the last 20, 30 years. And that's very good return in today's day and age. If you can get low double-digit returns for where the inflation is, where the interest rates are, and where the tax rates are, 10, 11% from the market is very solid return. And that's what I meant. And that's compared to the projected earnings growth, it's somewhat, lower. So I do expect that market is expecting a mid to high teens earnings growth. And as we move forward, maybe it'll slip a little bit on the multiple, but that's there's nothing wrong with it. And low double-digit return itself is very good from the market.
Okay, got that. Mr. Khemka, I want to ask you one question on the fintechs. Ever since the RBI tightened norms on unsecured consumer lending, take us through how you look at it now. I mean, you have one of the big fintech companies yesterday saying that they want to cut down on the low ticket size loans. But as soon as you move into the higher ticket sizes, there are the banks, there are the NBFCs. So how do you look at this entire pocket now?
So without talking necessarily about any particular name, and our team has always had very sizable exposure to financial sector, but most, if not all of that, at least amongst the lenders, is to lenders with very strong balance sheet. Some of the private sector giants who have very strong liability franchise. And so on. I think if you just step back and think of the RBI action, I think people have focused a lot more on the negative hit on the capital adequacy ratios or the negative hit on the cost of funds for some of these NBFCs who are more exposed to that retail segment. But I think on the positive side, what people I have not heard talk so much about, this is something that reduces the risk in the system. That was one of the risks we as investors and a lot of other investors were worried about and would constantly ask managements about, how they're addressing, how they're handling this potential risk that is building up. So RBI has taken a proactive step. And I think it definitely reduces the NIMs by a very small marginal amount. I think when you combine that by the risk reduction in the system, it is not necessarily a negative. It's much more sound system, hopefully, due to such actions from RBI.
Thank you, Prashant, for joining in, and hope you're a part of our journey as we get set to embark on the next 25 years. Thank you very much, sir, for joining in. We will slip into a very short break on that note. We'll come back and we'll talk commodities. Manisha Gupta will join in next.
CNBC-TV18, embarking on a quarter century of excellence.
Happy birthday, CNBC TV in India.
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back to the show, and let's focus on some of the equity market deals, which has been a big trend for the year 2023 as well. Let me welcome on the show Vishal Mahadevia of Warburg Pincus. Vishal, it's a great day to join us on CNBC TV18. We are celebrating our 25th birthday, and it's a good day for you. You've made 3 exits in this particular week, capitalizing on the run-up that we have seen in the equity markets. Over 5,000 crores worth of shares being sold from some of your portfolio companies, which have been very long-term investments. It looks like an end of an era for Bharti Airtel, CAMS, and even IDFC First, in which you hold only a minority stake. So, Vishal, first let's begin with this equity share sale and how Indian markets are providing exits to private equity firms.
Yeah, so firstly, happy birthday, Nisha, to the entire CNBC TV18 team. It's fantastic. 25 years, it's a great milestone. On the equity markets, you know this, you know our business model. I think most of our viewers know it. We are fiduciaries for our investors, and we're always in a position where we will continue to invest more and more into India, but at the same time, return money back to our investors in businesses where we've been involved and we've helped build them. And hopefully been part of something really successful, which you can say about all 3 of these companies, whether it's a CAMS, an IDFC First Bank, and a Bharti Airtel. So we're really thrilled, and thrilled that it's happening on the 25th birthday of CNBC TV18.
Yes, thanks for that, Vishal. So let's talk about all these 3 companies, the investors who have really now come in and bought your shares. What is the growth prospect that they are really looking at? Let's begin with IDFC First, that has a management change also announced today. And you have been with this particular company when it became a bank, and private equity players actually look for a piece of the banks. So why this exit at this time, and what is the potential for which the other investors have come in for?
Yeah, look, on all 3 of these, but let me go one by one. I think the bank is just a fantastic story. I think you'll recall we had sold some of our shares even a quarter ago to GQG, a terrific new name to come back on the shareholder table. We've been associated since Capital First, if you go back, 2012. It's been more than almost 12 years since we were invested in there, and less than $1 billion today. It's 20 billion of AUM, double-digit ROE, fantastic management team, credit to Vaidyanathan and his team. It's a real institution. And I was thrilled that we took our part in helping build the bank. And so I think it's going to continue to make money. I think it's going to continue to grow personally. I feel very good. However, having been here 12 years as a private equity fund, it is incumbent on us to also bring in the next set of shareholders, exit responsibly, and return that money to investors. And that's exactly what's happened with the bank.
That's right. And what about Bharti Airtel, a very, very long stay by an investor in that company, which also is not the type of investment that most of the private equity makes in a large Nifty 50 company. But why an exit, complete exit, and especially when telephony is moving towards the digital potential and the growth prospects there?
Yeah, look, I'll make an overall comment about all 3 companies. I wish if it was my personal money, I would like to hold on to them forever. I've been involved, and we've been involved at Warburg Pincus with these companies for so long, but Bharti Airtel, terrific future in front of it. I really wish the company the best. I think you mentioned it, it's a Nifty 50 stock. It's not really what we as private equity do. The ownership in Bharti Airtel, you go back almost 25 years to our first investment. What we've done here is really a result of shares that we got when we sold our stake in the DTH business back to the company. And as a Nifty 50 stock, good investors coming in, it felt like the right time as we were getting to year end to sell the balance. I just want to remind you, Nisha, we sold part of half our stake 6 months ago at 800 rupees a share. And those investors are really happy. And that they should be. It's a win-win.
That's right. Win-win for both the new investors and you getting an exit. But quickly tell me about the investments for this particular year. You'll be clocking in over $1 billion of investments as well. What are the themes that you're looking at, which is close to your heart for investments for future? And how much are you going to invest in the next year, Vishal, from Warburg Pincus?
Yeah, it's hard. Well, it's hard to predict next year. I mean, this year we'll be, I think, investing and committing close to 10,000 crores into Indian companies, and that's $1 billion to call it. Essentially, themes around financial services. We invested in a company called Vistar, fantastic business backing Abhijit Saha, who's formerly from ICICI Bank. We invested in Water Tech, which is consumer household fittings and appliances. We've invested in Everise, which is in the healthcare BPO business. And we're close to finalizing a last investment in the healthcare space. All themes that we are focused on and we continue to invest in. Your question's a tough one only because I'm really very bullish on India. We at Warburg Pincus are really bullish on India. You look at where we sit today, what the next decade brings. So the easier question to answer is, what are you not looking at? Which is, because there's opportunities everywhere.
Right. Vishal, thanks so much for your bullish commentary on India investments and more investments to really be pumped in by Warburg Pincus for the next year as well. And Vishal, also many congratulations now being the Asia head at Warburg Pincus. And thank you for joining us today. Thank you.
Thank you, Nisha. Good to see you.
All right, so that was Vishal Mahadevia from Warburg Pincus. Over 5,000 crore rupees of shares sold, but over $1 billion of investments lined up for next year. It's time for a short break on the show, but Manisha Gupta will be joining in with commodities on the other side. Stay tuned.
CNBC TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Now, off late, for the past 2 days, there has been a lot of reportage on whether the government wants to discourage the fact that a lot of sugar supplies get diverted to ethanol because they want to ensure that there is adequate supply of sugar. So to get us the latest on what we've learned on this entire story, Manisha joins in. Manisha?
Well, yes, there have been lots of market talk about on how the government could be looking to limit ethanol production from cane juice and B heavy ethanol there. The point is that this time around we're looking at a lower sugar crop, down by nearly 8% as compared to the previous year. Is the reason there's going to be no export of sugar as well. And the reports also do suggest that the government will want to focus on the sugar production, availability and pricing within the country, where we have seen prices also continue to rise up. But we have spoken to the Consumer Affairs Ministry and the Food Ministry as well, and the ministers there have told CNBC-TV18 that as of now no decision to reduce ethanol production has been taken, but the sources do tell us that there could be some proposal that is still under consideration, and you could hear about it in the days to come there. So that is what is keeping the markets quite jittery here. Let me also remind you that the sugar season for the country starts in the month of November, 1st of November that is. So for 2023-24, the ethanol guidelines and pricing are yet to come. There have been various tenders that have been floated. So what the street perhaps is looking at, that these tenders would be honored perhaps. But overall, the industry does not like this because there has been a lot of investment that has been done within for ethanol production. Because remember, there's a 15% target for this year and 20% until 2025. So a lot of sugar industry clearly has gone that way. This year, the focus could be on sugar. But remember, ethanol is a long developing story with what the government's vision has been. So there's a bit of a concern right now within the industry. But we haven't heard the last of it, and the expectation is that in the next couple of days or perhaps days going forward, we could be hearing on some kind of taper down or some kind of policy that could be coming out.
All right, Manisha, thanks a lot for getting us all of those details and that clarity on what we are seeing right now. By the way, yesterday, all of the sugar stocks were up and about in trade. Today, you're seeing pretty big cuts come through, and they've been holding ever since the morning. So everything from an EID Parry, Simbaoli, Uttam Sugars, all of these seeing a pretty big cut in trade right now. We do need to take a short break, but when we return, we're going to talk about the TV18 and E18, the fact that they will merge with Network 18. So all of the details on that big consolidation when we come back.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. You're still tuned into Trading Hour. Now, TV18 Broadcast and Network 18 are in focus after the news that TV18 and E18 will merge with Network 18 in a mega consolidation exercise. So, Mangalam is standing by the wall with all of the details on this. Mangalam?
Well, it is indeed a mega merger for the media sector. So let's talk about what's happening. TV18 and E18 will consolidate with Network 18 in a merger to bring together the television, digital, media and news dissemination operations under one umbrella itself. The idea is basically to build a media powerhouse that combines the strengths of three giants to bring you an unparalleled multimedia experience. So let's tell you what this portfolio really comprises of. For TV18, there are 20 news channels in 16 languages. Alongside that, we have the CNBC-TV18.com website as well. For Network 18, it brings you News 18 platform in 13 languages. Alongside that, we have the insightful firstpost.com as well. E18, you would know as the company that operates the widely used money control app and the website. Viacom, however, remains a direct subsidiary of Network 18, offering a portfolio of 40 TV channels, and we have Jio Cinema as well. And that's not all. In fact, Network 18 will also continue to hold its investment in the ever-popular Book My Show. Now, wondering about the numbers? Well, the merger ratio is set at 100 Network 18 shares for 172 TV 18 shares, which pretty much is in line with what the previous closing price of these shares were. E18 shareholders will receive a generous 19 shares of Network 18 for every one share held by them. And what's the best part? Reported consolidated financials will remain unchanged because as of now, there was holding already. So there will be a slightly higher public shareholding of Network 18 post the merger, and that's where the big change happens. You know, pre-merger Network 18 promoters held 75% stake. This goes down to 56.89%, and public shareholding as a result of which increases from 25% to 43.11% itself. So one would ask, what is the key rationale behind this integrated entity? It is that it promises not just news, but a seamless blend of cost and content strategies as well. From revenue synergies that would come through, bundled sales and ads to cost synergies, they will be achieved through unified operations and content procurement. And over above all of this, we have the ecosystem synergies, which will come by with diverse offerings under one umbrella. The state would also be interested in how this entire piece plays out in the future with integrated internet and cable technologies of the parent group. Obviously, the disclaimer as we are talking about this is that TV18 is the entity that houses that houses CNBC TV18, the channel that you are currently watching.
Thank you very much for that. We will slip into a break. We'll come back with more on the markets.
CNBC TV18, embarking on a quarter century of excellence. CNBC TV18, embarking on a quarter century of excellence.
Welcome back. Ircon is a stock which is down 6.5% in trade. Remember, the government is looking to sell 8% stake via an offer for sale. The floor price has been set at 154, and the stock, even after the 11 rupee correction that we're seeing today, is above that floor price. The price right now is 160. Floor price is 154, and the government wants to sell a total of 8%, which is a base size of 4%, plus the green shoe of about 4%. And that stock is struggling a bit. There is still no recovery in Paytm. Paytm opened straight away with a cut of about 20%, and it's still down close to about 18%. There have been multiple downgrades and target price cuts on Paytm. Goldman downgraded neutral as the company announced that they want to scale back on their smaller ticket loans. And another stock which has been weak since the starting of is Bharti Airtel, down 2%. The top Nifty loser, and Warburg looks to sell its balance stake in the company. So that's put pressure on Bharti Airtel. But with that, we're going to wrap up on Trading Hour. Thank you very much for watching. We leave you with 25 reasons why you should watch CNBC TV18.
You continue to be the first port of call for actionable, credible, verifiable information for news.
CNBC TV18, one goal, pursuit of excellence.
Over 2 decades of setting gold standards, over 2 decades of excellence.
All kinds of news starting from sports, politics, international affairs, cars, entertainment and whatnot.
Journalistic credibility at its finest.
One should watch CNBC TV18 because you know what, you'll hate to miss out on that money-making opportunity.
One reason to watch CNBC TV18 to stay ahead in the game.
Watch CNBC as we get to you the most unbiased and factual coverage of the ever-changing business landscape.
You need a reason to watch CNBC TV18. I mean, is there anyone else who's as good?
Watch CNBC TV18 because it is, and will always be the business leader.
Watch CNBC TV18 because the team and its work here just would not leave any alternative for you.
You know we're the market leaders, right?
Credibility and accuracy, no doubt about it.
Watch CNBC TV18 because we're in the business of creating wealth.
Best analysis in real time.
Well, we keep it classy. We're always with the news. We're the best in business.
And also because I'm on it.
Yes.
We're the best and we just keep getting better. Decoding financial jargon for the last 25 years.
Keep watching CNBC TV18 to stay ahead of breaking news in the world of business, ahead of when it actually happens.
Watch for news on the go.
Here's to the heart and soul of news, to the stories told and the milestones achieved.
It's your road to financial success.
Please watch CNBC TV18 for responsible journalism.
Come on board with us and reach new heights.
If you have to trust financial news, then it has to be CNBC TV18.
Well, watch CNBC TV18 because we are the best in the business.
Keep watching CNBC TV18.
Stocks oscillate in a narrow band after 3 sessions of heady gains. Auto leads gains while FMCG and metals drag. It's the mid-caps which outperform.
Network 18 plans to merge TV18 and E18 with itself to unify operations and drive content procurement and ecosystem synergies. Analysts say the move is a win-win to scale, reach and revenues.
Paytm says it's seeing good demand in higher ticket loans of rupees 3 to 7 lakh and it is looking to reduce the loans of less than rupees 50,000. Analysts see this shift impacting the near-term growth of the company and its peers and partners. Brokers cut their estimates, the stock lower.
IRCON slides after the government announces an offer for sale to offload up to 8% of its stake. IDFC First Bank sulks after 2% of its equity changes and a key executive exits, while Bharti Airtel slips on a trade of 0.8% of its equity.
Food Ministry officials tell CNBC-TV18 that there has been no decision so far to stop procurement of B-heavy ethanol by oil marketing companies. The proposal is still under discussion. The uncertainty spooks sugar stocks.
A very good afternoon. You're watching Halftime Report on CNBC-TV18. I'm Ekta Batra and with me is Mangalam Malu. Well, for today, the markets are pretty much in a consolidatory mode. They've probably stopped in order to celebrate CNBC-TV18's 24th birthday. But we have the mid-caps doing better. The mid-caps are up around 0.5%. So there's that party which is continuing there. But nonetheless, Mangalam, 24 years of credible journalism, accurate, timely information every time.
24 years entering into the 25th year, nearly a quarter of century. Ekta, you know, when I joined CNBC-TV18, I was probably younger than the time that CNBC-TV18 has been around for as well. But what's interesting is that not only are we leaders and not only are we leaders by far when it comes to financial reportage, I know for a fact that no one, and by virtue of being here for almost a decade now and a decade and a half for you, we know that no one works harder than us for our viewers and no one is willing to improve further more than us, for our viewers. And that's exactly perhaps what keeps us relevant still today.
Yes, absolutely. Adapting to what is an evolving media landscape. That's what CNBC-TV18 has been doing. But for today, we also have a market to trade. So let's get back to that. Like we mentioned, it is the broader markets which are doing better at this point in time. The Bank Nifty is consolidating. But remember, on a week-to-date basis, it's been a good amount of gains that we've seen for all of these indices. For example, the markets this month, the Nifty is up around 3.8%. The Midcap index is up around 3.5%. The Nifty Bank has rallied around 5%. So yes, we're taking a bit of a breather and that's par for course really for the markets. But let's get to our birthday celebrations. It's our birthday and we have a very special lineup of guests for you all through the day. In fact, Mangalam did catch up with Prabha Narasimhan, who's the MD and CEO of Colgate-Palmolive India, to discuss demand trends. Prabha expects the rural environment to remain volatile going forward. Listen in to this exclusive conversation.
What we are seeing is certainly a continued momentum behind premiumization. So we are seeing the premium products in our range do better and better, and we think that we have tremendous potential to drive that even further, whether that be Colgate Total or that be our visible whitening range of toothpaste or even our more premium toothbrushes. All of these continue to have very strong double-digit momentum, and therefore we are seeing no abatement to premiumization. As far as rural India is concerned, it has been up and down. We're still not seeing a consistent recovery. We see a few green shoots, but nothing consistent that we can yet talk about saying this is, a precursor to continued growth in rural India. So that one we are still watching.
So with confidence, you can't say that the worst is behind rural India. Would that be the correct reading here?
Yeah, I think the reading is that we're seeing pockets of better performance and pockets of not so good performance. So the jury is probably still out.
So what are the pockets of not so good performance and the pockets of better performance?
We're seeing tremendous momentum in the 20 rupee segment, for example, which is largely a rural India-driven segment. That segment continues to outpace the market and do really well. So that's one area that we are seeing a strong performance. Like I said, Colgate Strong Teeth has been relaunched. It is our flagship brand. It is also has a substantial part of its business coming out of rural India, and we're certainly seeing momentum there as well. So these would be a couple that I would call out.
What about, the input environment situation? You did say that gross margins are likely to improve going forward because of some moderation in input costs and also premiumization. You will also, pull back some of those gross margin savings into ad spends. How do both these factors look as we look at the second half of this year?
So we are continuing to see a fairly benign cost environment, which we are seeing, which we have seen over the last few months, actually, and that continues. A lot of our major input ingredients continue to be quite benign and actually quite stable at that benign level as well. In terms of where we will spend that incremental money, we have significant opportunity to grow the oral health in this country. So like I mentioned, one of our key focus is really on the idea of night brushing or brushing twice a day. And a lot of effort is therefore going behind the Sweet Truth campaign and all of the surround effects around that campaign. So that becomes an area of focus. You would have noticed in the last quarter that our advertising expenditure is beginning to creep up to support some of these initiatives.
So how much higher does the ad spend go? Because last quarter was around 14% of sales. Do you have a target band in mind?
We don't set a target for advertising. What we tend to do is to see what are the jobs that we have to do and what is the level of expenditure that's required to make sure that we're delivering to that outcomes that we are looking for. And then it gets added up and then prioritized and then run. But we don't have a band on which we run advertising.
We often speak about Palmolive and you keep saying that you intend to grow Palmolive twice your overall portfolio. How has that fared so far?
So I think it's been a mixed year on Palmolive. There have been, again, like I said, some areas where we've done really well. In channels of the future, we've actually had a very good year on Palmolive, whether it's modern trade or it's e-commerce. We have some work to do outside of these two channels, and that's the focus going forward for next year. We see tremendous headroom opportunity for growth because the categories in which Palmolive plays are growing in very, very strong double digit, or the categories of strategic interest for us are growing in very strong double digit. And so we see significant opportunity for us to capitalize and grow faster than category growth.
So let's put you in the spot before we let you go, Prabha. The growth targets that you have for the second half of this year from both a value and volume perspective would be what?
Mangalam, you know that we never give a guidance on growth targets. I just suffice to say that what we've seen so far this year has, I think, been a building momentum in this company and this fantastic brand. And I can only say that our continued plans look like we should be able to continue this momentum.
Continue or improve upon the growth?
I think you can read it either which way because momentum is momentum.
All right. And finally, you did say that there is a lot that you can talk about in terms of acquisition and you don't want to say much. What has happened here? We've been talking about this for almost 6 months now.
You know better than me, Mangalam, that acquisitions are not something that happen in a matter of quarters. They take time, they take effort. The only thing I want to say is that our commitment behind diversifying our portfolio and getting into categories beyond oral care remains steadfast. We have plans. The plans will take time and we are going to be patient behind those plans.
So is it the same acquisition targets that you were talking to and those conversations are going in the right direction, or some conversations have fallen through and you're looking for newer targets right now? Let's put it that way.
Actually, Mangalam, I'm going to desist from answering that question as well. Just suffice to say that acquisitions remains an area of interest for us, as does diversification using our global portfolio, as does growing the Palmolive brand that we already discussed.
But earlier it was very high up on the agenda. What happened now?
It is still very high up on the agenda. So, yeah, nothing has changed.
Well, that was a candid Prabha Narasimhan, who's the MD and CEO of Colgate, saying that rural demand is still a little patchy, though there are underlying trends of premiumization which are doing well. And the second half sees some momentum, and acquisitions is something that we will be tracking from a Colgate standpoint. Take a short break, come back. The lineup of strong guests that we have for you today on occasion of our 25th, us entering the 25th year continues. Viren Shetty, who's the Executive Vice Chairman, Narayana Health, will join us on our special birthday edition.
CNBC TV18, embarking on a quarter century of excellence. CNBC TV18, embarking on a quarter century of excellence.
Welcome back. Well, quiet day for the markets, broader markets doing better. It is our birthday week as we enter our 25th year, and this entire week we have been speaking to a whole host of top managements in India Inc. Let's now focus on one particular company, Narayana Health, which is in focus from the hospital space. The stock has gained more than 60% this year. And the Indian healthcare space itself has seen a strong rise in private equity investments. To discuss this and more about the business, we have Viren Shetty, who's the Executive Vice Chairman of Narayana Health, who's joining in. Viren, hi, welcome to the show. And thanks for being with us from the time you all got listed to now and apprising us of all of the details with regards to the hospital business. Just wanted to start by, in fact, asking you about 2023. It's been a record year for hospitals, not only in terms of the financials, but the kind of investments which have flown in from a private equity standpoint. What is your sense in terms of what has changed this year when it comes to hospitals? And are those statistics here to stay?
Fundamentally, this is a massive reflection of the demand that exists. As Indians, we don't have a lot of options when it comes to getting very high quality healthcare. And so you see a bit of a crowding effect where the highest quality of healthcare being offered at very few facilities at a price that most people can afford. And so the hospital occupancies, the numbers that you're seeing is a reflection of that. Now, in terms of the optimism going forward for investment, it's just our reinforced belief that people value their health. They are buying health insurance. They value the increased benefit that comes from going to accredited healthcare operators. And so we have to invest to meet that demand. But whatever that has been announced, it will only be a little bit of a drop in the bucket. There's still a huge amount that has to be done on the public sector, large number of doctors and nurses that need to be trained, but we're all doing our part.
All right. You are doing your part, and at the same time, you're creating wealth for investors and a lot of goodwill from society as well. Viren, I wanted to know your thoughts on the operational parameters as we see them right now. You've seen your margins improve consistently. Now they're at around that 23.5% mark. Where do those parameters stand as of now? And what does the second half of this year look like from a margin, average revenue per occupied bed and occupancy perspective?
So we are entering into Q3, which is a festive season, both in India and overseas. And what we've seen consistently over the past number of years, people tend to delay their elective procedures during this time. So volumes have dropped for us and for all healthcare groups across the country. It picks up after January. So October to December is generally a weaker quarter in terms of footfalls. So the margins will obviously see some compression because ours is a business that depends a lot on operating leverage. We manage very high fixed cost, huge amount of staffing, huge amount of overheads infrastructure, which if we don't get the volumes, you're not going to see. Q4 is where things pick up, and then we expect things to normalize throughout the year.
Okay. Well, traditionally, Viren, in the past you've mentioned that international patients is not really a very big focus for Narayana, but we are seeing a huge amount of demand come through, whether it's oncology, whether it's transplants, critical and high-end complex surgeries. Is that a space that you're probably looking at closely now simply because of the kind of demand and queries that you might be getting? What is it as a percentage of sales and what is the growth that you're anticipating?
As of today, it is 8% of our sales. It used to be 11% prior to the pandemic. And at 8%, it is representative of mostly just one country, which is Bangladesh, that is building up a large number of hospitals of their own in Dhaka, in Chittagong, in Sylhet. And so when that comes up, people will just not feel the need to travel to undergo the visa process, waiting in airports or traveling outside for healthcare. So healthcare, we believe, is a local phenomena. It's one thing that we want to provide for patients in a local area so they can drive and come to our hospital. So for us, it's a conscious strategic call to de-emphasize working after medical tourism and more focused on domestic patients within a 10-kilometer radius of our hospitals.
All right. Viren, I just wanted your thoughts on, once again, the operational parameters itself. You did say that by the fourth quarter, you will have some numbers normalize. The third quarter is seasonally weak for you. So could you give us a sense of what normalized numbers mean for you in terms of occupancies, average revenue per occupied bed? And at the same time, you have a bunch of new hospitals as well. Is your, Mumbai hospital on track for break-even this year? How has the performance there been?
Depending on the month, the Mumbai hospital does break even from time to time. During the summer holidays, obviously not, because no child wants to get operated on during the holidays. But it is virtually there. The other two hospitals that we run are both in Delhi. Both are more or less at the break even. The hospital we run in East Delhi is profitable. The hospital in Gurugram is nearly there. The outlook that we have going forward for a lot of the hospitals in terms of the occupancy is, on average, we hover between 60 to 65%. It will be lower in Q3, it will be higher in Q4. And that is a number that will keep improving, but except that we're adding more capacity and we're doing a lot more things to make sure that the length of stay comes down. And so what that happens is that occupancy is a target that you never quite reach, because the shorter the length of stay, the more procedures we convert to daycare. It's better for the patients that they don't have to spend their time in the hospital. And so the occupancy number doesn't inch up. Rather, we focus a lot on patient volumes. We want a large number of patients to come in through our facility every day.
Okay, all right, Viren, we're going to let you go on that note. Always a pleasure. Thank you very much for joining in on what is a very special day for our channel as well. Thanks very much for taking the time out. We'll take a short break, but up next, we'll get you more on the markets, a lot of stocks and companies lined up, so stay tuned.
CNBC TV18 Embarking. CNBC TV18, embarking on a quarter century of excellence.
Welcome back. You're watching us here on our special edition of Halftime Report on CNBC TV18. What we're doing here is celebrating CNBC TV18 entering its 25th year today as well, for which we have no one but you, the viewer, to thank. But talking about the viewers, an important news piece coming for you, halftime, FNO update. We're closing in on that 20,900 mark. Dips on the Nifty have been bought into as well. So the easiest trade for option writers on weekly options expiry day is usually to write straddles. We've seen a lot of writing at the 20,850 put. And this, I presume, would be in the first half of trade itself. That's telling you that, support for the market has built around that 20,850 mark, a level from which we bounced today. And now that we're at the 20,900 mark, we're seeing writing on both the 20,900 put and the 20,900 call. So as you can see, the 20,900 put has a premium of around 15 odd rupees. The 20,900 call comes up for you, has a premium of around 20 odd rupees. So those who are writing this are playing for a 35-point range around that 20,900 mark. So there could be some resistance upwards of 20,935 and support around 20,865 itself. In terms of individual stocks, a lot of short positions being added on Balrampur Chini. My sense is that it may get into FNO ban in today's trading session after the kind of short build-up that it's seen. So we'll keep an eye out on this one. And a lot of long positions being added on Container Corp and Tata Power. Both these stocks doing well. Tata Power running for the second straight session.
Okay, all right. So that's what's taking place in the FNO space. But I think we can probably get you more perspective in just a bit.
In just a bit. What we'll do is actually take a short break, come back, and then we have another special guest lined up for you on Halftime Report today.
CNBC TV quarter century of excellence.
Welcome back. Well, let's talk to a company now which has really outperformed this year. So on a year-to-date basis, the Nifty Pharma Index is up around 28% as compared to, say, Lupin, which has outperformed quite significantly. Lupin, the stock, has given returns of around 70% on a year-to-date basis. We have with us the management. We have Mr. Ramesh Swaminathan, who is the Executive Director, Global CFO and Head Corporate Affairs, joining in to discuss the business as well as the way forward. Mr. Swaminathan, welcome to the show and thank you for joining us on a day where we are celebrating 24 years of existence. Wanted to start by asking you about the US business, because I was just reading a Kotak note that came out this morning on your company. And one of the things that they have mentioned is that, the US business can probably hit $1 billion to $1.2 billion in terms of an annual run rate of sales. When do you expect that to happen, and which would be the key drugs which would contribute to that revenue target?
At the outset, thank you for having me on, and congratulations to CNBC and happy anniversary. Regarding US, as you're aware, we were pivoting to more complex generics over time. We have been actually focusing on this for the last several years, so to speak, but it's time to actually to harness that. You're right about the fact that we are looking at about $1.2 billion over the next 4 to 5 years from US itself, which is a quantum jump from what we are doing currently, which is about $750 to $800 million. The current run rate is about $200 million. This is on the back of, in fact, several good products that are coming through. As you would know, we launched tiotropium, which is doing fairly well, as with albuterol. The entire respiratory portfolio will continue to do extremely well for us over the next 5 years. And you could expect the same thing from potentially the injectables, the complex injectables that you'd be launching. So we have been focusing on that, and we have, in fact, a good pipeline of those products as well. So the next 5 years, we would be kind of unleashing those products into the market. We also have a fairly decent pipeline when it comes to ophthalmic products and biosimilars, which you could be bringing into the market. The OST portfolio it's not as though it's going to be lower from a focus perspective, but it'll still contribute a fairly decent sum overall. So if you fast forward 5 years, you could expect about $250 to $300 million to come from respiratory, about $250 odd million from our injectables, and the balance coming in from ophthalmic and potentially biosimilars, and of course the OST portfolio.
So $1 billion in the next 5 years, that's how we take it. Mr. Swaminathan, thank you so much once again for joining us. Just wanted your thoughts on Spiriva generic. How is that ramping up for you? I mean, analysts have estimates of anywhere between $130 to $160 million worth sales coming in the next 2 financial years. Can you surprise them positively?
It's coming up very well, and as you would know, there is no generic competition to this. The jury is still out as to whether there would be an authorized generic at some point of time, but it isn't there at this stage. So we would continue to do well for the next at least 2 to 3 years insofar as this particular product is concerned. I would actually say that the entire respiratory portfolio is shaping up pretty well for us. As you know, we have, in fact, products outside America also. So we are looking at this as a global platform across various of the markets. And it's an extremely important portfolio for us. And we would do all that it takes to bring in the entire range of products out there. And we believe that we have the wherewithal to bring in a full range out there over time.
Just a quick 2-part question. Suprep, there is competition which has come in because Strides has received approval for that particular drug, as well as your view on margins, because now you're, tracking 18% already. What are you probably exiting the year with?
Yeah, so insofar as Suprep is concerned, you're right. There is generic competition coming in from Strides. So to the extent the franchise will do, and that's true with any generic product. So there is a big upside on launch, and then it lasts for some time, then it comes down, and that's true with Suprep as well. The second question relates to margins. As you would know, we have been focusing on improving our margins. It has been lower than our peer group for quite some time. And over the last 5 quarters, we have, taken several steps to kind of take it up, successively, so to speak. And last quarter, we actually ended up with 18.7%. We do believe that there is, enough steam to kind of take it forward, successively over the next several quarters as well. The focus, of course, is on, moving the top line with a lot of good products across various geographies, including America for sure. We've added about 1,000 people in terms of sales force in India, and that would potentially start delivering a lot more, in the second half, so to speak. And there's, of course, a tremendous focus on keeping costs on a range, so to speak, which all of this has contributed and will continue to shape our future as well.
Just a quick last word, and if you could just, answer monosyllabically, next year exit run rate for margins?
It'd be much higher than what it is today.
22, 23%?
The intention is to get it to 22% over time, but it will happen for sure.
Okay.
All right. Thanks a lot for joining in on our special day, and on many occasions in the past. Every time we've reached out to you, you've been generous with your time. Mrs. Swaminathan, wish you good luck, and hope that our association continues for the next many years as well. With that, we'll slip into a short break. On the other side, we have Nilesh Shah joining in to talk about the markets and also celebrate with us as we enter our 25th year.
CNBC-TV18, embarking on CNBC TV18, embarking on a quarter century of excellence.
Welcome back. You're watching us here on Halftime Report. The Midcap Index continues to do well at the high point of trade, and alongside that we have the Nifty Bank, which has recovered as well, blinking between the red and green lights. But we're celebrating our 25th year on CNBC TV18, and to celebrate with us, we have a friend and market expert, Nilesh Shah of Envision Capital. Nilesh, thank you so much for joining in and your support through the years as well. I remember the last time we spoke, you said three things. One was that oil remains to be a variable. Secondly, elections continue to be a variable. And thirdly, banks, while fundamentally are doing well, the stocks are not performing. A month later, oil is down to $75. Elections are largely, a conclusion, a foregone conclusion for 2024, given the state election results that have come by. And the Nifty Bank is up 5%, led by your favorite HDFC Bank. I mean, is there anything else you could have wished for?
Thank you so much for having me on this occasion. It's a wonderful day. It's a great day. And it's been wonderful part of being your journey, our journey, India's journey of these very momentous 24 years. And best wishes for a very exciting future to you, the entire team, and all your viewers. And look forward to being part of this journey ahead. So congratulations and best wishes for even more wonderful times ahead. Coming to the market, it's like, pretty much Mangalam saying if wishes were horses, and you're right that whatever you could hope for, think about, or wish for has pretty much materialized in the last few days. And you're right that crude is kind of gone sedate despite the geopolitical challenges. The election verdict of the 5 states clearly bring a lot more certainty to the potential outcome in 24, and yes, banks have participated. So couldn't hope for more, and it looks like that we seem to be kind of ending this calendar year on a great note, and we hope to kind of have even a more wonderful 2024. So yes, I think right now can't think of a more benign environment. Truly think this is India's Goldilocks moment.
Okay, all right. Well, Nilesh, getting into 2024, celebrating 24 years of our birthday, I'm going to ask you a question in context of the next 24 years then. If you have to pick up a sector from current levels, which will probably turn into an outperformer in the next 24 years, which one would it be? I know stocks are difficult, so I'm asking about sectors.
Wow, that's crystal ball gazing, but one, I'll probably risk with 2 sectors, and that's because over the next 24 years, we seem to essentially be headed for times when our per capita income growth would be significantly higher. We would be more aspirational, and so I clearly believe that premium discretionary consumption is one big area where I see some of these businesses, which probably today are in a few hundred crores. I wouldn't be surprised if these businesses actually end up with revenues of maybe thousands of crores, or maybe profits, which would probably be north of 1,000 crores. So I clearly believe discretionary consumption is going to be a very, very rewarding place to be in. And the second is essentially the businesses around investments. Clearly, you're going to see a nation of savers becoming a nation of investors. And so clearly over the next maybe 24 years, you're going to see probably 20, 30, 40 trillion dollars of accumulated savings, which could get canalized into on the investment side. So I think a whole bunch of investment-led businesses will be strong wealth creators. So I would think discretionary consumption, premium consumption, so you could call that as aspirational or premiumization. And the other essentially is more risk-oriented or risk-taking set of investors, which is around financialization and savings becoming more of investment. So I think these are the 2 big pockets, which I think are expected to do extremely well over the next few decades.
All right, Nilesh, we were tempted to ask you about the risks to the upsides that we are seeing right now in this blue sky scenario, but we'll leave that for another day. On our birthday, we'll only talk about all the good things. Thank you so much for joining us. Wish to have a conversation with you soon again as well. With that, take a short break, come back. On the other side, we'll get you the commodities arena. Manisha joins in, and she's recorded a special conversation with Amul.
CNBC-TV18 Embarking. CNBC-TV18 embarking on a quarter century of excellence.
Welcome back. Let's focus on the commodity sector now. Amul tells CNBC-TV18 that they are aiming to achieve a turnover of 1 lakh crore in the next couple of years and have no plans of listing, as it is contrary to the objectives of a cooperative. Manisha Gupta did catch up with Jain Mehta, who's the MD of Amul, to talk about the company's business outlook, future expansion. Listen in.
This is actually the time for the strong tailwinds to the sector. I've been here for more than 30 years now, and I'm very, very clearly seeing that the focus of the government in demonstrating the power of cooperatives and ensuring the benefit to the smallest and the marginalized farmer, the landless people, even showing the role of cooperative in women empowerment. That's giving a strong impetus to the sector. So the new Ministry of Cooperation, which has been formed 2 years back, it's been led by the Home Minister himself. And more importantly, the 3 new multi-state cooperatives, which Amul, IFCO, CRIPCO, NCDC, NAFED, NCCF, all 6-7 of the top cooperatives in the country have been given an opportunity to incubate. So we are actually a startup for these 3 new startup mode for these 3 new multi-state cooperatives, one on exports, one on organics, and the third on seeds. And I'm happy to say that the organic one is doing very well, and more importantly, the export one has already got orders worth more than $2 billion. So this is the power of connecting the farmer through a cooperative to the world. And the good beginning has been made, and I'm sure it will do a lot of wonders to improving the incomes of our farmers across the country by providing a stable market access, remunerative prices, and more importantly, quality products to consumers around the world.
You know, the last couple of years haven't been really easy for the consumers because the way the prices have continued to rise. I mean, I do understand that the input costs have gone higher as well. But what has happened in the last couple of years? Do you see that pattern growing ahead also? Where do you see is really the issue?
Last year was an abnormal year because 2 years prior to that were COVID period, and we could not take the increase in the prices because on the one side the inflation was there for the farmers, but because of huge inventory and the pressure on the markets, the producers had to absorb that. So to overcome that, we did increase prices a couple of times last year. But now the situation is pretty okay in terms of overall availability of milk, the growth in production of milk, and the input costs are pretty under control. The government also did its bit by controlling the exports of the de-oiled rice bran cake, which is an input to the cattle feed, and that has stabilized the prices, and the pressure on the producers is not much. So, and you've seen in now almost a year is over, and we have not hiked the prices. Overall, we look the situation to be quite okay. And comforting both for the producer as well as the consumers. And this is the tightrope walking we have to keep doing.
All right. So with so much happening under that one brand umbrella, what would you say is the company's valuation in the day and day today?
It's a good question. Amul means priceless in Sanskrit. So it remains priceless.
But there are numbers, there are papers you work on.
You can't put a number to this and the zeros to it, and the way you and your channel looks at it, that will be Greek and Latin for us. But again, as I mentioned, we talked about large numbers of milk, large number of turnover, value, growth, and all that stuff. But actually our currency is not milk. Our currency is trust. And it's the trust of lakhs of producers, trust of 1 billion consumers, and that's what keeps the brand going.
Let me approach it in a different way.
What we get out of it is the value which both farmers benefit out of it and consumers benefit.
Okay, so what was the turnover last fiscal, and what are you looking to do now in the next year?
The Amul brand turnover was about 72,000 crores last year, $9 billion. We are growing at double-digit rate this year. We have a target to become 1 lakh crores in the next couple of years. But that's pretty much achievable.
Sure.
What important is we demonstrate not just this impact of Amul in whatever space we are doing, and we'll build on that momentum. The 3 new multi-state cooperatives and the opportunity we've got to incubate these new companies, which actually can become bigger than even Amul what is now. And then also demonstrate the power of this model in different parts of the world. And this becomes a showcase example of basically how a cooperative with the role of women empowerment actually demonstrating this.
So, I'm sure that's a question that gets asked to you very often. Is there ever going to be a listing? Is there ever going to be an IPO?
It's actually contradictory to the objectives of a cooperative. We pay the highest price of milk, and the consumer gets the best product at value for money price. So we have to work with very low margins, low cost, low overheads, and low expenses. An investor looks at value, and he would look at profit. And you can get profit only by either increasing the prices or reducing the purchase prices. Now, which means you will have to make a producer unhappy or a consumer unhappy, or actually both unhappy, or in the worst case, the market unhappy. Actually, we don't need so much of money from the market. Money is not very difficult to come. The cooperative sector is getting stronger.
Especially
the balance sheets of our organization and dairies are getting stronger. And the multiplier effect on investments is very high. So that way the payback period is very low, the returns are very good, and we are investing big time into expanding our capacities. And about, if you can imagine, 11,000 crore rupees investment in the next couple of years speaks of the opportunity the Indian market offers to us and the optimism farmers have in the market.
CNBC TV18, embarking on a quarter century of excellence. A century of excellence.
Stocks oscillate in a narrow band after 3 sessions of heady gains. Auto leads the gains today, while FMCG and metals drag. Midcaps outperform.
Network 18 plans to merge TV18 and E18 with itself to unify operations and drive content procurement and ecosystem synergies. Analysts see the move as a win-win to scale reach and revenues.
Paytm says that it is seeing good demand in higher ticket loans of rupees 3 to 7 lakh. And it is looking to reduce the loans of less than 50,000 rupees. Analysts see the shift impacting near-term growth for the company and its peers and partners.
Food Ministry officials tell CNBC-TV18 that there has been no decision so far to stop procurement of B-heavy ethanol by oil marketing companies. The proposal is still under discussion. The uncertainty spooks sugar stocks.
The finance minister says she doesn't want to be a spoilsport as the first Feb budget is just a vote on account, a budget to meet the expenditure till the next government comes to power. Hello and welcome. This is a special episode of Business Lunch today. As you can see, we are all dressed up and decked up in our studios and our newsroom celebrating our birthday. And from Pavitra, myself and the entire team of Business Lunch, we thank all our viewers for being part of this journey and always supporting us. So happy birthday, CNBC-TV18. And Pavitra, good afternoon.
Good afternoon. You know, it's been such a wonderful journey, right? All through the years, we've had the audience's support and loyalty as well. Yes. And here's to the next 25.
That's right. And equity markets, we shouldn't forget that that's been booming with so much action happening. That's the one action which is keeping us going all throughout. So let's focus on the equity market action today. The good news is that Nifty 50 is not too far away from its all-time highs, which it recently touched. But the bad news is that it is finding difficult to go above a certain level, still holding on to 20,900 levels. In a very tight range, there has been a little bit of volatility, and still it is on the flat line with a negative bias at the moment. So that's Nifty 50 just holding on to the 20,900 mark. Bank Nifty has been flirting with the red and green side, absolutely flat. And where is the real action coming in from for today is the Midcap universe, almost 0.5% up, and that's also pumping up the market strength with advances on the higher side. On my screens, Bharti Airtel, because of the huge share supply, is one of the biggest percentage losers. Pavitra.
Oh, absolutely. You know what also stands out, that this entire CPSE pack, which has been doing very well, it continues to just build on gains, right? So for the week, the CPSE index is up 5%. You have a lot of those names, Power Grid, NTPC, which are continuing to move higher. The Adani group of stocks also doing well. On the downside, you're seeing, individual names such as Paytm that is under pressure today. You have the entire pack of sugar stocks because of that uncertainty that we were mentioning. So that entire pack is seeing some cuts as well. The financials have recovered a fair deal, but still trading with some cuts. It's been a 350-point recovery on the Nifty Bank. That's what's going on with the market action. We'll come back to this, but let's kickstart the show now. As CNBC-TV18 enters its 25th year, we've been getting to the brightest and biggest minds in an exclusive conversation with us. ITC Sanjeev Puri says that the domestic economy is fairly resilient, but exports do remain a bit of a challenge. Speaking to Parikshit, he says that volume and margin have started to improve for the company. So listen in to some snippets of that conversation.
I think India is certainly has great potential, and India is today the fastest growing economy, and it is so because of a lot of purposeful interventions that have happened, policy making that has happened over several years. And I think what we are seeing is the fruits of that, whether it's the manner in which physical infrastructure has been built, the manner in which economy is empowered with the digital infrastructure, the health of the the financial sector, the health of corporate balance sheets, and the growing consumption in India. All of that are positives. Now, what are the risks is really to do with the external sector. It's to do with the fact that large parts of the world are not doing well. You spoke about China, and I think the concerns are certainly not only in that geography. The concerns are beyond that. The Western world is not facing a great growth. It's in fact there are risk of recessions and so on and so forth. And that's what's impacting our exports. So despite the fact that the external sector is weak, the Indian economy is doing well. In fact, Q2 GDP numbers are a testament to how well the economy is doing, and I think all that is a result of course, the spirit of enterprise in India, the resilience of people, but also, I think, enabled by a lot of very timely and purposeful policy interventions over several years. And there's no doubt in my mind that India is going to emerge as a global economic powerhouse. It's already the 5th largest economy. Before the end of this decade, it should be the 3rd.
What do you think is the consumption picture right now? Are you seeing consumption demand pick up here onwards?
So I think part of the answer was what I said in the beginning, that the domestic economy is fairly resilient. Of course, not all pockets are doing as well, and part of the impact is also because of the challenge we are facing with respect to exports and some of the after effects of inflation. And of course, India has managed inflation well, but it's not insulated from the rest of the world.
Right.
We're relatively better placed, but yes, we have faced the brunt of higher pricing.
Is it putting pressure on pricing, sir? Would you be forced to increase prices across?
No, inflation is an area that is now more under control than was there in the past. In fact, right now is a situation where in large areas the prices are actually being reduced, and you've seen it in the market across sectors. What I was referring to really is the after effects of a lot of inflation that has come over a period of time. Now we are seeing a situation where the commodities are cooling off, but they are still above, I would say, what they were pre-COVID. They were still above it, and a lot of it is again related to the external factors, and also the facet about the climate risk, the climate emergency, which is also causing its own bit of inflation.
Right. Now, in terms of volume growth and also in terms of margins, what would be your outlook?
We have seen that volume has started to move up, and because inflation is also been much more modest, so margins have also started to improve from Q2.
All right. My final question to you would be about CNBC-TV18's 25th anniversary, sir. You've, of course, been on the channel several times earlier. You've spoken to us often. What would be your thoughts and your message for CNBC-TV18?
I'd like to, first of all, congratulate you and everybody in CNBC for 25 years. I think it's an important milestone, and I think it's certainly a milestone to celebrate, because CNBC has done well. It has done well, aligned to very well its objectives on focusing on economic issues that matter for nation building. So I'd like to congratulate you and wish you the best for the next 25 and 50 years and 100 years.
Thank you.
All right, away from ITC, let's shift focus to one stock, which is the stock of the day for all the wrong reasons, for being under pressure this afternoon, following the company's management call yesterday and also brokerage views on the stock. Abhishek Kothari, our colleague, is right here to get us the key highlights of what's really impacting and putting pressure on Paytm today. Abhishek.
Well, to begin with, Paytm in the presentation did mention that there is good demand seen in higher ticket size loan, that is loans between 3 to 7 lakh ticket size in the low risk personal as well as merchant loans. In consultation with lending partners like Aditya Birla Finance, etc., Aditya Birla Capital, etc., they will reduce less than 50,000 ticket size of loans and expand into higher ticket size loan. So merchant loans that they give out is to MSME segment, and it is a secured loan. Because it is a business loan, and hence it does not get impacted from the RBI regulatory point of view. They'll continue to build on loan distribution business, and they will expand their lending partner base. One large bank and 2 NBFCs in Q4 FY24 and in Q1 FY25. Now, Jefferies has written on Paytm, they have a buy recommendation. Target price has been cut to 1,050 from 1,300 earlier. They said that the BNPL, buy now, pay later, recap recalibration follows system tightening. So these disbursers, the BNPL disbursers, form about 55% of overall disbursers, and they will halve in next 3 to 4 months. So the impact on loan growth disbursers is for FY24 from 98% it comes down to 65%. For FY25 from 49% it comes down to 5%, and for FY26 it comes down from 43% to 27%. So the revenue cut estimate is between 3 to 10% for FY24 to FY26, and the impact on EBITDA adjusted for ESOP is at 14 to 16% over the next 3 years. So they also say that re-rating will take some time. Back to you.
Abhishek, thanks a lot for that. 18% cut on Paytm today. It is time for a short break now, but when we return, an important story, TV18 and E18 will merge with Network 18. So we're going to bring you all of the details on this big consolidation when we come back.
Congratulations to CNBC, and you guys are the gold standard when it comes to business reporting. So I'm glad to be here and wish you guys another very successful 25 years from here on.
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. You're watching Business Lunch. Now, as promised, TV18 broadcast and Network 18 are in focus after TV18 and E18 will merge with Network 18 in a mega consolidation exercise. My colleague Manglam Malu is joining us now with all the details of this deal. Manglam.
A mega media merger, that's exactly what is taking place. TV18 and E18 will consolidate with Network 18 in a merger to bring together the television, digital media and news dissemination operations under one umbrella itself. The idea here is to build a media powerhouse that combines the strengths of all the three giants to bring you an unparalleled multimedia experience. So to start with, let's tell you what the portfolio of each of these organizations or each of these companies encompasses. We have 20 news channels and in 16 languages, along with the CNBC-TV18.com website under TV18. Under Network 18, we have the News 18 platform across 13 languages and the insightful firstpost.com. E18 owns and operates the widely used Money Control app and the website, whereas Viacom, which remains a direct subsidiary of Network 18, offers a portfolio of 40 TV channels and Jio Cinema itself. And that's not all. Network 18 will also continue to hold its investment in the ever-popular Book My Show. Wondering about the numbers here? Well, let's tell you that as well. The merger ratio is set at 100 Network 18 shares for 172 TV18 shares, which is at par with the previous closing prices of these shares itself. And E18 shareholders will receive 19 shares of Network 18 for every one share that they hold. The best part, reported consolidated financials will remain unchanged. But there will be a slightly higher public shareholding of Network 18 post the merger, and that's where the big change happens. So promoter holding of Network 18 right now is 75%. Post-merger, it comes down to 57%, and as a result of which, public shareholding increases from 25% to 43.1%. So the question is, what could be the key rationale behind this integrated entity? Well, it promises not just news, but a seamless blend of cost and content synergies as well. From revenue synergies coming in through, bundled sales for options and also ad sales coming in, to cost synergies as well, which will be achieved through unified operations and content procurement. At the same time, the ecosystem synergies which will come in with diverse offerings coming under one umbrella itself. The state would also be interested in how this entire piece plays out in the future with both the integrated internet and cable technologies of the parent group too. Obviously, as we're talking about this, the disclaimer is that TV18 is the entity that houses CNBC TV18, the channel that you're currently watching.
Okay, Manglam, thanks a lot for getting us all of those details on this big consolidation that we're going to see in the media space. We do need to get into a short break now, but there's lots more news and updates in just a bit. Stay tuned for that.
CNBC TV18, embarking on a quarter century of excellence.
Because there seems to be some uncertainty over how the government will move on ethanol. So we have Manisha joining us to take us through what's really going on with sugar. Manisha.
Well, yes, there have been lots of market talk about on how the government could be looking to limit ethanol production from cane juice and be heavy ethanol there. The point is that this time around, we're looking at a lower sugar crop, down by nearly 8% as compared to the previous year, is the reason there's going to be no export of sugar as well. And the reports also do suggest that the government will want to focus on the sugar production, availability and pricing within the country, where we have seen prices also continue to rise up. But we have spoken to the Consumer Affairs Ministry and the Food Ministry as well. And the ministers there have told CNBC-TV18 that as of now, no decision to reduce ethanol production has been taken. But the sources do tell us that there could be some proposal that is still under consideration, and you could hear about it in the days to come there. So that is what is keeping the markets quite jittery here. Let me also remind you that the sugar season for the country starts in the month of November, 1st of November that is. So for 2023-24, the ethanol guidelines and pricing are yet to come. There have been various tenders that have been floated. So what the street perhaps is looking at, that these tenders would be honored perhaps. But overall, the industry does not like this, because there has been a lot of investment that has been done within for ethanol production. Because remember, there's a 15% target for this year and 20% until 2025. So a lot of sugar industry clearly has gone that way. This year, the focus could be on sugar. But remember, ethanol is a long developing story with what the government's vision has been. So there's a bit of a concern right now within the industry. But we haven't heard the last of it. And the expectation is that in the next couple of days, or perhaps days going forward, we could be hearing on some kind of taper down or some kind of policy that could be coming out.
All right. Thanks so much, Manisha, for giving us all those details on this industry. Now, the upcoming budget, just a vote on account, says the Finance Minister, Nirmala Sitharaman. Now, speaking at the CII event, she said that she expects no speculation or speculative announcements or big announcements, spectacular announcements, I beg your pardon, coming in from 1st of Feb. So it will be a vote on account, especially also we know that it's the election year. Listen in to the Finance Minister.
I'm not going to play a spoiled sport, but it is a matter of truth that the 1st February 24 budget that will be announced will just be a vote on account, because we are in an election mode. An election happens during the summer, the coming summer. So the budget that the government presents will just be able to, or would just be a budget to meet with the expenditure of the government till a new government comes to play. So, and that budget, following the British tradition, is called vote on account. So no spectacular announcements are made at that time. So you may have to wait till after the new government comes in July, will be the next full budget, July 2024.
All right, that is the word from the Finance Minister. But with that, we're going to wind down in this edition of Business Lunch. Thank you all for tuning in. We have Midcap Radar up in 2.
CNBC TV18, embarking on a quarter century of excellence.
20 points, though it has recovered 70 points from the lows of the day as well. What's doing really well is the Midcap index. That one is up around 230 points. So it's all about the Midcaps today. But we do have a very strong lineup for you on the show as well. So let's get started. We do have some managements waiting by.
Absolutely, we do. And since you spoke of Midcaps, it's been all about the Midcaps over the last month, hasn't it been? And as you mentioned, we have a very special lineup of guests all through the day. And first up, we'll put the spotlight on Dixon Technologies, and the stock has surged more than 54% this year. And the company recently inaugurated a new manufacturing facility in Noida, which has an annual capacity of 25 million units. Now, to discuss this and more, we are being joined by Mr. Atul Lal, the Managing Director for Dixon Technologies. Mr. Lal, good afternoon. Thank you so much for joining us this afternoon on our very special day. I'd like to start off by asking you about this facility. Can you tell us more? And is this the peak capacity of 25 million units that you're expecting? Do you expect more to add on to this in the near future as well?
Thanks very much for inviting me, and heartiest congratulations on your 25th year of successful execution. Responding to your question, this particular facility that we have set up for smartphones in Noida, it has a capacity of 25 million. We have 3 facilities. The combined capacity across these 3 facilities is around 70 million. Please appreciate that the total Indian market is around 150 odd million of smartphones and 70 to 80 million of 2G phones. So that's around 230 million. And the total addressable market for outsourcing, and please appreciate that we are outsourcing companies, around 140 to 150 million. So we're already at 50%. In case there is more visibility of an order book, which is already very healthy, then definitely we will not hesitate in expanding more capacity.
Okay, all right. So you are looking at expanding capacity, of course, depending on the demand that you get as well. Mr. Lal, always a pleasure speaking with you. You have given a guidance of FY24 volumes, which could be around 3.6 to 3.7 million units. Does it consider all the capacity expansions that you have in place in Q3, Q4? There are a number of plans coming up, or I would say product expansion plans that you have in place.
So I think your question pertains to a consumer electronics domain. Yeah, so that's mainly for televisions. The television volumes are going to be somewhere around this range. Let's see how Q4 pans out. But that's our internal budget number for televisions, around 3.5 to 3.6 million units. In the case of mobiles, the volume is much, much larger. We are hitting a volume of almost 5.5 million units per month.
Mr. Lal, the last time you spoke to us, you mentioned that your mobile order book is pretty healthy. Can you put a number to that? And I'd also like to add by asking you that you may also mentioned that you're going to start exports for Nokia. What is the timeline that you could share with us for the same? When is it likely to commence?
So order book for mobiles undoubtedly is very healthy. We have had a couple of major customer acquisitions for which this new facilities has been set up. Some more customer acquisition are in works. Hopefully, we should be able to conclude them in the forthcoming quarter. That's Q4 of this fiscal. We are glad to announce and share with the stakeholders that Nokia exports has already started. The consignments are getting shipped out of the country from December itself. Yeah, so that has already started.
Okay, all right. So consignment to Nokia has already started exports in that particular segment. We'll ask you more questions on exports, but Mr. Lal, I had to ask you on the ODM mix. In Q2, you did see margins expanding across most of the segments except for security systems and lighting. This was led by higher ODM mix. Can you give us a sense of what ODM to OEM mix be, say, 2 to 3 years down the line, and what would that do to your margin profile?
So ODM in absolute terms is going to increase very significantly. We offer our own solutions, mainly in televisions, lighting, washing machines, and the new product category that we are about to launch in a month or so of refrigerators. We are also working on telecom devices, wherein we would be owning the IP and offering our own solutions. However, at the same time, the largest trigger of growth for us is mobiles. And we are also pursuing IT products, which is prescriptive manufacturing. So in absolute terms, I reiterate, the ODM revenues are going to substantially increase But as a percentage, I think the prescriptive part, the EMS part, is going to be much larger portion. Now, responding to your comment
please carry on,
the margin on the security surveillance systems, it was primarily because of shifting our facilities to a new campus in Cooperative. Please be rest assured that the operations in Cooperative have stabilized and margin will be restored from the current quarter itself. The order book looks very decent. In the case of lighting, the market is demand is fairly slow, so I think it's going to take some time.
Mr. Lal, one final question from my end. You mentioned in your previous answer that there are some customer acquisitions that are in the works. Would you be happy to share some names? Are you in talks with any particular customer whose acquisition would you close in the fourth quarter?
So these are large global brands. I request just be a bit patient. Let it conclude, and then we'll share all the details.
Okay, all right. We'll do that, Mr. Lal. But thank you so much for joining us today on our special day and talking to us about Dixon Technologies and the plans going ahead as well.
Thank you so much, and heartiest congratulations on 25th year once again. All the best.
Thank you so much. Thank you for being a part of this journey. With that, we'll slip into a short break. Parminder Chopra, Power Finance Corporation, will join us to discuss their business outlook and the quarter gone by. So stay tuned for that.
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. Well, let's get the next corporate conversation going. Power Finance Corporation is the stock on our radar. Remember, the stock has seen a 215% up move in the year so far. As far as the business is concerned, in the second quarter, disbursements increased by 91% on a YY basis and 44% on a sequential basis. To discuss the business, the outlook, trends and more, we are joined by Ms. Parminder Chopra, who is the Chairman and MD, as well as Director of Finance of Power Finance Corporation, to take some questions. Ma'am, thank you so much for joining us today on a special day. And the stock has done really well, but there have been a lot of opportunities that companies have been talking about as well. So give us a sense of what is the opportunity that you're seeing in the renewable sector specifically. We spoke to REC yesterday. They said that the CERC-led capacity addition would require 30 lakh crore of funding. How much of that would be a pool for PFC going ahead?
Thank you very much. And first of all, heartiest congratulations on the 25th anniversary.
Thank you so much.
You said that there is a 30 lakh crore of total capex expected in the power sector in the next few years. Until now, we have been funding approximately 25% of the total capacity addition and in the power sector. And we expect that this momentum is going to go forward, and we will continue to support around 20 to 25% of the total capex addition in the power sector.
Ms. Chopra, good afternoon. Thank you so much for joining us on a very special day. My next question is in two parts, actually. I'd like to first ask you about how is the state of the DISCOMs, how is the health of the state DISCOMs currently? Are they making repayments on time? And part two of my question is, what is your exposure to these state electricity boards, and whether there are any delayed payments that you're facing? And if so, what is the quantum of the same?
See, state DISCOMs, everybody knows that it is in the past that state DISCOMs have always been under stress. But thanks to the two reform major schemes which have been introduced in the recent past by central government, one is a late payment surcharge scheme and the other one is the RDSS scheme, which has helped to reform the sector on overall basis. Late payment surcharge scheme has infused the liquidity across the power sector value chain, which includes the transmission GenCos, and also had reduced the burden on the state DISCOMs towards the late payment surcharge. Apart from that, there is a new scheme which has been introduced by central government, that is the RDSS, where PFC and REC are the nodal agencies. Total outlay of the scheme is 3,03,000 crore. And the expectation is to reduce AT&C losses after the successful implementation of the scheme to 12 to 15%. And if we see for the last 2 years, there has been constantly major reduction in the AT&C losses. It is also expected that at the end of the scheme by 25-26, there will be a zero gap between the cost and the supply. So that is going to give a financial stability to the DISCOMs, and their overall viability will improve. Your second part of the question, that there have been certain delays for the payment from the DISCOMs earlier, but now we are seeing that all the DISCOMs are paying regularly and in a timely manner. On the overall state sector book, which includes generation, transmission and distribution, there has never been any default. So as on date, the total book consists, PFC book has 83% exposure to the state sector. So we have not experienced any default on the state sector book till now.
Okay, all right. So 83% of the book comes in from the state sector. So in that case, Mr. Chopra, is there any outlook on change in the loan mix? We are seeing different ways or segments of power sector coming up as well. How do you look at that going forward, the loan mix that is?
See, right now, if you see PFC book, so if I talk of the disbursements during the first half of the current financial year, the majorly disbursements are towards the distribution sector and the renewable. Distribution sector, as of now, most of the states have they are under the state sector only. And in case of renewable, it is primarily, you can say 95 to 98% is towards the private sector. So slowly, the mix is changing. It's more towards private sector growing and lesser towards state sector, because now no more new generation projects are being conceived by the state where major disbursements were going on earlier. But it still take time. Maybe in the next few years, you will see the actual change in the mix.
It'll take the next few years to see the change in the mix. But Ms. Chopra, one final question from my end. What is your outlook on the cost of funds? Have they peaked? And if I may ask, what is the outlook on the margins as well? Have they bottomed out?
The cost of fund, if as on 30th September, PFC has a cost of fund of 7.41%. There has been a view that longer for higher. So we are expecting the rates to remain on a higher side for a few some more time. So definitely that puts pressure on the spreads as well as on the margin. But what has happened in case of PFC, that we have most of our borrowing at a fixed rate. So the reflection on the cost is gradual in case of PFC by any change in the market scenario, be it the increasing interest rate scenario or a decreasing interest rate scenario. So the transition is a bit slow on the overall book of PFC. So once the cost is increasing, we are increasing our interest rates to the borrowers, and accordingly, the reduction is being passed on when the interest rate scenario is on the lower side.
Okay, we take that point. If you can just give us a number, the NIM number in the first half was 3.37%. Considering the interest rate cycle that we are in, how do you look at this number going forward? And your AUM growth as well has been strong. How do you look at it for FY24 and FY25?
See, NIM, we are expecting that we will be able to maintain between 3 to 3.5%. And on the yield, yes, yields have dropped. Earlier, we used to have more than 10%. Now, if you see on the first half, it was at 9.85%. So earlier, when the interest rate scenario was on the lower side, we have passed on the reduction in the interest rates. But for the last 2 quarters, we have been increasing the interest rate, and accordingly, you will see that pressure on the yield is going to go lesser going forward in the next few quarters.
All right, Ms. Chopra, thank you so much for sparing time and joining us on this very special day. We wish you good luck for the second half of the year. That was the management of PFC. The stock has done really well for itself in 2023. Let's slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. We'll be right back.
CNBC-TV18, embarking on a quarter-century of excellence. CNBC TV18, embarking on a quarter century of excellence.
Welcome back. You're watching Midcap Radar here on CNBC TV18. The markets remain quiet, but the Midcap index continues on its merry way. It's up for the 25th day in a row, and that index is up another 0.5% today. And with that, it's a wrap on this edition of Midcap Radar. From Sonal, myself, and the entire team that put this show together, thank you so much for watching. Thank you so much for being part of this journey for all these years. MF Corner takes the action forward. Stay tuned. We'll be right back.
CNBC TV18, embarking on a quarter century of